Managers stick to the reflation trade amid signs of recovery. Taxation revolution. The world's richest nations meet in Venice, setting the stage for an overhaul of corporate taxes. We're live on the ground in Italy. Plus, a China stock index in Hong Kong teeters on the edge of a bear market amid Beijing's crackdown on the tech sector. Good morning, everybody. Welcome back to the European Market Open, the second hour of our programme. And European equity market futures do point to the upside. But remember, of course, we lost quite considerable ground here. European stocks down, or Euro stocks 50 down by more than 2% in session yesterday. So we certainly underperform US stocks, which also lost ground, but only around a 0.7% or so. So we're certainly watching this rebound, watching for signs of this rebound here on European stock markets this morning. A lot of people questioning the reflation trade. Where does that go as we see concerns around the virus, the Delta virus in more developed markets, also in less developed markets and in some developed markets with low levels of vaccination. So there's a whole host of different narratives going on when it comes to the Delta variant and what might make the markets nervous about it. But certainly that is something we're watching, something that seems to be getting back into the conversation when it comes to overall market moves, a focus on the virus. Let's get to the markets then, and we've got the FTSE 100 up by 0.4%, the CAC 40 up by 0.6%, the IBEX up by 0.4%. So we are making these moves to the upside, not making up for what we lost yesterday, but we are moving to the upside. In yesterday's session, we seem to be spooked by concerns around growth, and it was those same concerns around growth maybe that sent investors piling into treasuries and sent yields on US 10 years down to 125 or so. So let's talk about where we are on these markets right now. 10-year Treasury, the 10-year Treasury yield is on course for one of the biggest weekly slides since June last year, despite ticking up a little bit this morning. Joining us is Stephen Major, HSBC Global Head of Fixed Income Research. Stephen, very good to have you with us this Friday morning. Nice to speak to you. So we see risk assets gaining a little bit of pausing perhaps for thought, or gaining a bit of poise after yesterday's sell-off that we saw. It seemed that the pace and the size of the moves in treasury markets spooked other assets. Can you give us your insights into what it was that was driving treasuries yesterday, earlier on this week? We seem to have been testing the downside when it comes to yields. What's been driving that, Stephen?
Well, to put it into context, Anna, we started the month at 1.5 and we've been below 1.3 for the 10-year Treasury. To me, this is the correct direction of travel, because we're forecasting 1% by year end. I'm a little bit surprised by how fast it's happened. So to answer your question more directly, I think most people thought something else was going to happen. And you've documented the so-called reflation trade that involves people being short of treasuries and other government bonds and expecting the yield to go up. Now, the market had been pricing in the higher inflation all the way through the back end of last year and even into the first few months of this year. So yields peaked at the end of March. That's more than 3 months ago. And we've probably seen the high for yields. That markets move ahead of the data. And I think that the issue here is that many investors and traders may be overly reliant on the incoming cyclical data and underrepresenting the longer term structural drivers that make it very difficult for the rates to go up at all anyway.
Okay, and in terms of those longer-term structural drivers, what are the ones that you would point to? What are the ones that keep us heading down towards 1% on the US 10-year, not up towards 2%, as some others might suggest?
Well, you see, these are things that don't go away. And you know about the debt overhang and the impact of technology, wealth inequality, demographics, etc. These don't go away. And they determine the rate that we will get to when and if rates ever go up. Now, some people might call that the terminal rate. It's like the longer run dot on the dot plot, which is 2.5%, by the way. It looks very unlikely that if and when they start to hike, that they're going to get anywhere near to that level. So if you put your mind on to the idea that 2.5% is too high for the destination point, then you've got to decide when do they start hiking and how fast do they go. So you've got three pieces to put together. And to me, the market has been overestimating the speed and the magnitude of the hikes when and if they come.
Right. And is that because we all got just too carried away by the reflation narrative? We got carried away by the anecdotal evidence and the very documentable evidence of supply chain disruption, and we thought maybe it's going to stay around for longer than it will. We got overly excited about reopening economies, maybe a little bit too quickly, and that meant that everyone was wrongly positioned in treasury markets. Is that what's been going on? And do you think the market has got to a point where we have a better understanding then of where inflation heads?
Yeah, I think you've probably explained it much better than I did, Anna. So I speak to a lot of investors, and there's no doubt there's been a lot of supply side anecdotes and about the bottlenecks, and everyone's got their favorite story about the price of something that went up. That is not sufficient to drive the forecast on a 10-year treasury. You've got to weigh, in terms of the pandemic, you've got to weigh the supply bottlenecks up against the longer-term scarring impact. And that's speaking to where the potential GDP is. And that's, again, linked in to where the policy rate could get to when and if it goes up. I'm stressing that point. People have been investing and behaving as if it's a done deal, that there's really high inflation and rates are going up. Now, on the first of those, on inflation, the market was priced for 2.5% CPI average for the next 5 years. That was back in March and April. 2.5% for 5 years average. That is a done deal in terms of what the Fed's been aiming at. So it was in the price. And as for the rate hikes, as I say, I will believe them when I see them.
Okay, and you don't think we'll get back to 2.5%. So in terms of where the scarring that you mentioned there, Stephen, and what that does to economies as we try to recover from the global pandemic, one of our colleagues, John Author's, flagging some academic research that talks about after pandemics, and they've looked back at Spanish flu and various others through history, and talk about that the natural rate of interest rates tends to fall after a pandemic. Is that... That's something that supports your line of argument, I suppose, and is that something you're thinking about?
Totally. Yeah, totally. Now, I haven't read that piece, and I must do. I know that at Jackson Hole last year, the focus was the pandemic, and there was some academic papers then talking about potential GDP being lower. So that's focusing on the scarring. Think about here in the UK. It's true that on the one hand, you've got short-term inflation pressure because there seems to be a lack of people to do the jobs. That's a simple way of explaining it. But what's happened to the potential GDP due to Brexit and the pandemic? Did that come down? If that's the case, which I suspect it did, then the destiny rate, the equilibrium rate that we're going to, is going to be much lower than in the previous cycle. Now, that's what matters to bonds. That's the thing that really matters, not this month's inflation print.
Right. Let me ask you though, what is the biggest risk to your view, Stephen? What is it that you worry about when you tell me confidently that rates, the US 10-year is going down to 1%?
Yeah, well, look, any forecast is a probability-weighted mean of some kind. It's not like a best case, a single modal forecast. So what I'm saying is we are alive to these risks, and maybe we could have played the reflation move better ourselves in the first quarter. I think in the second half of the year, we've got incoming information from the US Treasury, for example, about what their issuing plans are. We'll have to look at that. The data could be very volatile because we are going through the reopening trade. That's a bit of a cop-out, so I apologize, but a lot of people will tell you the same thing. It could be very volatile, which of course is sort of unaccountable statement.
It could be very volatile, and we'll keep our eye on the data. Stephen, thank you. Stay with us. Stephen Major, HSBC Global Head of Fixed Income Research, stays with us on this programme. Coming up, we will ask Stephen for his thoughts on the ECB. The ECB confirming that Bloomberg scoop we talked about yesterday morning, raising its inflation target to 2%. The bank has completed its new strategy review. We'll discuss that next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 11 minutes into our European trading session, and stocks rebounding from yesterday's losses just a fraction. We are up by 0.6% on the Stocks Europe 600 after we lost considerably more ground in yesterday's session. My colleagues tell me that all sectors on the Stock 600 are in the green. That gives you a sense of how broad the rally is today. Let's have a look at some of the stocks that are on the move individually, and we'll start just glancing to my right with Airbus. We've got Airbus stock moving up by 2.8% for the French-listed plane maker. The deliveries accelerate to surpass the 2020 first half total, which is obviously good news in this sector. It also got a boost as it won part of a major purchase from one airline over in the United States. So that's boosting the case over at Airbus. Burberry in focus, the luxury sector in focus generally. We heard about the M&A intentions of Caring earlier, but the Burberry story is an upgrade at Goldman Sachs. That's a stock that's been under pressure, but up by 2.5% on that upgrade this morning. And then we'll finish with another bit of M&A news. Philip Morris essentially going shopping for Vectura, this business that operates in a similar space, but it's received an offer from Philip Morris, and Philip Morris trying to beat some interest from private equity in this particular business. Vectura Group PLC up by 12.5% this morning. Let's get a Bloomberg Business Flash, some of the other corporate stories we're covering this morning. Here's Laura.
Thanks, Anna. Becoming an investment banker requires an enormous amount of work. That's the warning from Cantor Fitzgerald CEO Howard Lutnick. He says junior bankers complaining about long hours should rethink their choice of a career in the industry.
Young bankers who decide that they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young. You should know it going in and make those decisions in life. To complain about it after you got this great job, I don't know, just seems a little silly.
Pfizer says it will request U.S. emergency authorization in August for a third booster dose of its COVID-19 vaccine. The move comes after early data shows that it can sharply increase immunity protection against the coronavirus. The company has received initial data from an early human study showing that a third dose of its existing vaccine is safe and can raise antibody levels by 5 to 10-fold compared with the original vaccine. Job openings in London's finance industry are at almost triple the level of a year ago, ahead of the UK's exit from COVID restrictions later this month. According to data from recruitment firm Morgan McKinley, there were more than 3,300 jobs available at the end of last month, the highest level since January 2019. That's the Bloomberg Business Flash. Anna.
Thank you very much, Laura Wright here in London. Now, the ECB has completed its first strategy review in almost 20 years, confirming that Bloomberg scoop that we were discussing this week. It is changing its inflation target to 2%. We reported yesterday that the new target would replace the old below but close to 2% model with a simpler 2% plus headroom. ECB President Christine Lagarde said the move would strike a good balance whilst allowing the bank to support Europe's green transition.
Yesterday, the Governing Council unanimously approved the ECB's new monetary policy strategy. The Governing Council considers that price stability is best maintained by aiming for a 2% inflation target over the medium term. It replaces the previous double key formulation of below but close to 2%. The new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling. The Governing Council therefore decided to account explicitly for the implications of climate change and the carbon transition in our new strategy. We believe that this 2% is clearer, simpler to communicate, solid, and a good balance.
Let's get the thoughts of Stephen Major, HSBC Global Head of Fixed Income Research, who's still with us. Stephen, is it clearer to you? We heard there from Christine Lagarde. We're hearing this morning from Olli Rehn, Governing Council member, of course, saying that this new goal is unambiguous and clear.
Yeah, it was coming, and most people in the market, I think, expected the ECB to move to something more symmetrical. And to me, it's part of the global rates story. In the space of a few weeks, we've had these developments in Europe and signs that rates could even be going in a downward direction in China, for example. And then we were discussing the US earlier. So it's all part of a global picture. And in some ways, the ECB and the Eurozone were out of line with other big central banks, because the Bank of England, Bank of Japan, for example, they're all looking at targets which they are happy to overshoot and undershoot and try and balance things out. So I think it was fairly clear this was going to happen, but it's still support for the dovish view on rates, in my opinion.
And we're also hearing this morning comments from Olli Rehn saying the goal allows aims like full employment to be emphasised. I suppose it might make the ECB in line with other central banks, but it won't necessarily lead us to know exactly what reaction function the ECB is going to have in any given circumstance, Stephen.
Yeah, if there's one thing we've learned in recent times is that maybe central banks want a bit more ambiguity. Maybe they need to be a bit more enigmatic, because having explicit targets, it just sets you up to fail, really. And think about it from the Fed's point of view. They have a dual mandate, and the employment side of that mandate sort of paints them into a corner a bit, because they are so far away from full employment, and they've revealed what those numbers are. So maybe it makes sense to be a bit ambiguous.
And where does this leave you with your rates view then, Stephen, when it comes to European markets? So we've got the German Bund yielding negative 0.3. Where next?
Yeah, well, our forecast is -50 for year end, and the Treasury forecast is for 1%. So those forecasts haven't changed because of the recent developments. If anything, it's moving a bit more our way. We're only halfway through the year, Anna. And the thing is with these forecasts, that they're not wrong or right until we get to the forecast horizon. So for me, there's still a long way to go. But the direction of travel is downwards for yields, not upwards.
Okay, halfway through the year, very close to a very important football game, Stephen. Just 2 more sleeps until a very important football game. Now, you're a man of numbers. You're somebody who models things very seriously for a living and comes to very learned conclusions. What are your learned conclusions without any sense of personal bias telling you about what's going to happen on Sunday evening?
I'm just happy that we're there. I mean, based on the number, based on the numbers, it's almost a coin toss, isn't it? It'll probably go the whole way. It might go down to penalties. It's probably going to be agony again. I hope not, Anna. But it's so exciting. I'm still recovering from the last match, so.
I am too. I mean, some of us have to get up pretty early, and that certainly the extra time and the penalties, it takes its toll. But Stephen, thank you very much for joining us. Stephen Major, HSBC Global Head of Fixed Income Research. Thank you very much for joining us. And Stephen will be continuing his conversation with us on Bloomberg Radio. That's at 9 a.m. UK time. Coming up on this programme, is it coming home or going to Rome? It's England versus Italy. We might have mentioned it a couple of times. In the Euro 2020 soccer football final this Sunday, we'll take a look at what the highly anticipated event means for equities. Call it what you like. It's happening on Sunday night. More analysis of that next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the European Market Open. 23 minutes into our European trading day, and European equity markets bouncing pretty nicely from some heavy losses, though, yesterday. The CAC 40 in particular up by 1.3%. Bit of M&A to talk about this morning, helping certain sectors. Now it is England versus Italy in the Euro 2020 final at Wembley this Sunday. On the pitch, the winning side will lift the coveted trophy. Off it, a range of consumer stocks could get a boost from the event, whatever the results. Bloomberg's Joe Easton joins us with a rundown of the sectors that are set to benefit from the fever pitch. Joe, this wouldn't be Bloomberg TV if we didn't lend the sort of markets focus to what's going on here. I heard Danny Berger asking you this question earlier on, and she was saying, is it all about pubs and beer? I would love to think that the answer is more sophisticated. Is it?
Well, there is a lot of pubs and beer involved, but usually we do look at the pub stocks as the main sort of beneficiary. The interest in the games when England are in the tournament stays really high, and as soon as England are eliminated, which usually happens quite early, people lose interest and tend to go to the pub even less for the games that didn't involve England anyway, so the footfall drops. This time around, obviously, we've had the social restrictions, so pubs haven't been able to pack their venues out. So instead, we've seen a shift towards the grocery stocks, the supermarkets, and with people stocking up on booze and snacks, and also the delivery stocks. So Just Eat has the main sponsorship for the whole tournament, and Deliveroo sponsors the England team. So they've done quite well as well. And then there's the bookmakers, which I find really interesting. So you can see in the data that during June and July of tournament years, the new client numbers actually increased by around 100%, so they double versus non-tournament years. So it's a really big way for bookmakers to attract new clients, and also clients that haven't gambled for a while come back on, reopen their accounts, and the stocks do quite well as there. Obviously, there are social implications whether or not that's a good thing, but in terms of the investors, it is a positive for them.
Yeah, there's certainly plenty of the bookmaker advertising happening during the games, isn't there? Let me ask, I mean, you referenced the supermarkets doing well versus pubs, certainly something that Tim Martin at Wetherspoons has mentioned. So a lot of people trying to work out what's going to happen, of course, trying to get a sense of what the end result's going to be. Goldman Sachs has been modelling this. What sort of credence should we attach to the model, do you think?
Yeah, so it is an economic model, so it's a statistical model, and basically the important thing to remember is it is based on averages. So basically the model would say that if we played the tournament 1,000 times, an infinite amount of times, Belgium would have won the tournament according to the data. So the model is correct, even though Belgium were eliminated. That doesn't mean the model is inaccurate. The model does work. Now it predicts England will come home. But football will come home to England. England will win the tournament. But the note says probably. So the key word is probably. It's a probability model, and it is based on probability rather than fact. We're only playing the tournament once, which means we don't know who's going to win. But if it was down to probability, Goldman predicts England would win.
Okay, and if that's wrong, then that probably was doing a lot of heavy lifting, wasn't it? Well, we'll see. Thank you so much, Joe, for joining us. Joe Easton there. You certainly got the impression from the front pages of yesterday that just being in the final was, in a sense, some sort of victory for the England team. So we'll see whether that has lifted some of the pressure. Coming up on this programme then, global tax reform. That's top of the agenda when the finance ministers of the G20 nations meet. We'll be speaking to the French Finance Minister, Bruno Le Maire, live from Venice. We will bring you that conversation shortly. This is Bloomberg.
had been due to happen on... That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Friday morning, half an hour into our cash session, and European equity markets moved to the upside. Off highs, though, up by 0.5% on the Stocks Europe 600 as we try and bounce back from some of the losses of yesterday. Now, G20 Finance Ministers and central bankers are meeting in Venice today. Top of the agenda, the global minimum tax rate of 15% agreed at that G7 meeting in Cornwall, and more widely, thanks to OECD-led negotiations. They're expected to endorse the deal at the G20, but key details need to be hammered out. More nations need to sign up, and full implementation could take many years. For more, we're joined by Maria Tadeo, who's on the ground for us in Italy, in Venice, with a guest. Maria.
Yes, Anna, good morning. We're here in beautiful Venice with amazing weather, and we also have an amazing guest joining us. Of course, the French Finance Minister, Bruno Le Maire. Thank you for being with us. And, you know, of course, we know that for years you've been pushing for this digital tax. It's something that you've made your battle horse to some extent. How confident are you that we get a full deal by the end of the week?
I'm very confident. And I think that we could have, during this G20, a groundbreaking agreement on international taxation. And you know that France has been pushing for that international agreement for more than 4 years. So we are on the verge of having this agreement. It would be good news for all G20 member states. It would be also good news, I think, for the rest of the world.
And you know, the Irish, just to give you one example of the countries that are not fully convinced, they say we can work with taxing in the country where you make your services, but the 15%, that's not something we can accept. When you look at this, is this a full package, or can you get to a hybrid solution?
Of course, a full package.
So both?
Both. And we need to have a full package. We need to have Pillar 1 digital taxation, the taxation on digital giants being decided. And we also need to have the minimum taxation being decided with a level rate of at least 15%. And let's be very clear, for France, we aim at having more than 15% for the minimum taxation.
So how much would you want to see? You know, what are you targeting?
I don't want to give a specific figure, but I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century, with the digital giants being taxed in a fair way, and with this minimum taxation, which will put an end to the race to the bottom on the taxation system. So once again, 15% for the minimum taxation on corporate tax is a minimum, and France aims at having more than 15%.
And let's just say best case scenario, we get to Sunday, there is this deal, everyone agrees on it, but it will still depend on the U.S. Congress. You also have your own national tax. So what's going to happen there? Are you going to drop your tax? That's automatic. And what happens in the U.S.? Are they going to get this done?
I've been discussing this point many times with Janet Yellen. And we have, as you know, a very good and friendly relationship with the Biden's administration. I want to take a very clear commitment for the French government. As soon as the international taxation and the digital taxation will be implemented, France will withdraw its own national taxation. And I'm ready to take not only a political, but also a legal commitment. In the French finance bill for 2022, I'm ready to introduce the commitment that as soon as this OECD taxation system is implemented and enters into force, we will withdraw our national taxation. I really want to avoid any kind of concern for the US people, not only for the US administration, but for the US people. We are fair. We stand ready to withdraw this taxation as soon as international taxation has been adopted and implemented.
So make it legally binding. Okay, that's a good point. And, you know, I also have to ask you, next week, you're working also on an EU digital levy. That's created a lot of confusion, meaning what's the rationale of doing this a few days after you get a deal at the OECD? What's that about?
I think that we should recall what is the purpose behind that, behind the digital levy. The idea is to have new own resources for all European countries. You know that we have decided an economic recovery plan of 750 billion euros. And we have, of course, to find fresh money, which means that we need new own resources. There are many tools that have been put on the table by the Commission. There is the digital levy, but there is also the carbon border adjustment mechanism. There is the taxation on financial transactions. So there are many tools on the table, and we will discuss those tools. And we stand ready to discuss with the US administration all the tools that are currently examined by the Commission and by the EU member states. We will have the chance to discuss with Janet Yellen on Monday in Brussels. So let's be open. Let's listen to the concerns of the US administration. We have, once again, a friendly relationship between Europe and the US, and we should build on that.
And, you know, just as a final question, I know you don't like to comment on the central bank, it's independent, but yesterday we had the strategy review with the 2% now inflation goal, also that climate mandate. I wonder, you know, what's your thoughts on that, without getting too...
The ECB decisions is clearly a great and good news for all member states, EU member states, and especially for the 19 members of the Eurozone. First of all, because the ECB has been able to find a consensus in a few weeks, which means that the ECB is ready to take quick decisions. I think that under these times of crisis, this is of the highest importance to have the possibility of taking quick decisions. Second, because the ECB has decided to put some more flexibility in the monetary policy. And once again, since we are under very special times, having this flexibility being decided by the ECB is very good news. And third, for the first time in the history of central banks, there is a climate goal that has been defined by the ECB. I'm very proud of what has been decided by the ECB and especially by the leadership of Christine Lagarde, because Europe, once again, is the first continent to have this climate goal being decided at the level of a European central bank, which means that we are taking the lead on the fight against climate change, using the tool of monetary policy, using the tool of a central bank. That's good news.
Okay, and I have to ask you, because we're in Venice, there's a big game on Sunday. Who's going to win that? Is it England or Italy? And you are surrounded by Italians, so...
My bet is that it will be Italy.
Voilà. Very good.
Grazie.
Monsieur le Maire, thank you so much for joining us on Bloomberg TV, as usual. Anna, there you have it. It's going to be Italy.
She says, convinced and convincingly. Maria, thank you very much. Maria Tadeo, our reporter on the ground in Venice, speaking with the French Finance Minister, Bruno Le Maire. Let's take a look at some of the stocks that are on the move this morning and get a sense of where we are, what is leading the rebound across these European equity markets, because we are rebounding a little from yesterday's losses. And if you look at the sector breakdown, you can see that there's just one sector in negative territory. That is energy. Oil prices are a little bit higher this morning, but they're not as high as they were earlier on this week, of course. We're not at $77 a barrel. We're at $74.49 on Brent. Brent. That is up 0.5%, but still energy names lagging. Travel and leisure to the upside, and it's not all travel and hotels, though, that move higher. Some of that is gaming stocks moving higher this morning here in Europe. Let's get a Bloomberg First Word News update. Here's Laura.
Thanks, Anna. A large UK study has found most young people face an extremely low risk of illness and death from COVID-19 and have no need to shield from the virus. The research found under 18s in England had about a 1 in 50,000 chance of being admitted to intensive care with coronavirus during the first year of the pandemic. Conditions that were previously thought to increase dangers, like active asthma or cystic fibrosis, brought very little risk. President Biden says the US is on track to end its military mission in Afghanistan by August 31st, even as the Taliban makes gains amid the withdrawal. Biden reflected on America's longest war, which will end just before the 20th anniversary of the 9/11 terrorist attacks. He said while the US will continue to provide support, it's not there to build a nation, adding others in the region must step up their efforts.
U.S. support for the people of Afghanistan will endure. We will continue to provide civilian and humanitarian assistance, including speaking out for the rights of women and girls.
The US is reported to be planning to add at least 10 Chinese entities to its economic blacklist over alleged human rights abuses and high-tech surveillance in the Xinjiang province. According to Reuters, the move could also include companies from other countries. The US has already put import bans on cotton, tomatoes, and some solar products from the region. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much. Laura Wright in London with an update there of the First Word News we're covering this morning. Coming up on this programme then, one small step for man, one giant leap for extraterrestrial tourism. The race to space is taking off. We'll give you the details next. This is Bloomberg.
This week on Bloomberg Green, the green industrial revolution.
One of the core issues with green steel is that it is fundamentally more expensive to make than polluting steel.
Steel is a vital ingredient for many green technologies, but its production burns billions of tons of coal each year. How can the industry clean itself up?
What goes into your recycling bin at home, more than 80% is actually being landfilled or incinerated.
Super product, ecological nightmare. We take a look at the plastic problem and two companies trying to solve it.
Few have realized that meeting the goals of the Paris Agreement isn't just about advancing clean energy or capturing carbon dioxide from the air. The world will also have to find ways to keep most fossil fuel reserves in the ground.
And from border taxes to outright bans, government and regulators are stepping up the war on carbon emissions, all in the pursuit of net zero. I'm Kaylee Lyons in New York, and don't miss this week's edition of Bloomberg Green, airing on TV and on Quick Take this weekend.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I think Satellogic is amazing. So Cantor Fitzgerald, we invested $25 million in the company at the pipe, meaning at $10. We just bought $25 million worth because we think this company is going to do incredible things and really change the course of data from space. I mean, I hate to say it, but space is the final frontier. And I think this is incredibly exciting. The space market is vast, $140 billion addressable market annually for the data coming out of space. Amazing.
That was Howard Lutnick, Cantor Fitzgerald's CEO, talking about his investments in space and the massive potential for that market. He's certainly excited. Now, sticking with the burgeoning space industry, after years of hype, extraterrestrial tourism is finally taking off, with both Jeff Bezos and Richard Branson set to cross the final frontier this month. We took a look at another scheme bringing space one step closer.
Looking for a vacation and have $125,000 laying around? You could float into the stratosphere on a space balloon. A new company called Space Perspective is changing the space travel game, aiming to use giant space balloons to bring 8 people at a time to a 19-mile-high, pitch-black lookout for astronaut-style views of the planet Earth. Its hydrogen-powered balloon flights went on sale June 23rd and are slated for takeoff in 2024. According to the company, they've already sold more than 200 tickets. The company's co-founders met while taking part in Biosphere 2, the famed failed experiment of the early 90s that explored the viability of human life in outer space. Since then, the pair has served as technical advisors to Elon Musk on human spaceflight, built life support systems for space exploration, and helped set records for the highest space balloon flight ever recorded. When their vessel, Neptune 1, gets its finishing touches, likely in late 2023, it will join a nascent space tourism industry, which is finally bearing fruit after years of hype. Also in June, Virgin Galactic got the green light to fly to space from the FAA. But Space Perspective is different from its competitors in several key ways. For one, it doesn't actually reach outer space. Although definitions vary, NASA sets that boundary beyond the mesosphere, 50 miles above sea level. International bodies put it higher at 62 miles, a measure known as the Kármán line. Neptune 1 gets only a third as high, achieving epic views but no time in zero gravity. The trade-off is a safer, smoother flight that requires no pre-flight training for its passengers. Those who book will arrive on site a few days before a trip, allowing some time to visit the launch pad, tour the capsule, and make sure everyone feels comfortable. The trips will last about 6 hours, departing well before the crack of dawn in order to see the world's most spectacular sunrise creeping out from behind planet Earth. Along the way, space travelers can get out of their reclining seats, eat a fancy breakfast, order mimosas from a bar, or chat up the pilot, who doubles as a tour guide. Eventually, the balloon will slowly deflate, and the capsule will land gently in a large body of water, where a special boat will pick it up and bring the passengers back to shore. Space Perspective expects to conduct around 25 flights in its first year of operation, ramping up to 100 flights per location per year. The goal, say the founders, is to scale quickly and bring space tourism to the masses, or at least those that can afford it. This is Where To. I'm Nikki Eckstein. For more on the future of travel, follow us on your favorite platforms.
The balloon gradually deflates and lands in a body of water gently. I feel like I've seen that movie, and I'm not sure it always ends well, but good luck to anybody who tries. That was Bloomberg's Nikki Epstein on the future of space tourism. It is indeed a very exciting weekend for this topic, because coming up this Sunday, we'll have live coverage of Richard Branson's historic journey into space aboard his Virgin Galactic craft. So don't forget to tune into Bloomberg TV for that special programming beginning at 2 p.m. London time. Let's go to Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Philip Morris has agreed to buy asthma drug maker Vectura Group for $1.5 billion. It's one of the biggest moves yet by a tobacco company towards treating conditions that its cigarettes can help cause. The offer trumps an earlier bid for the UK firm by Carlyle Group back in May. For the first time since the pandemic began, US hotels are outperforming pre-COVID levels. Revenue per available room, which combines occupancy and prices, was more than 5% higher last week compared to the same period in 2019. That's according to data firm Analytics STR. Phoenix in Arizona saw the best gains of any major market. Hotels in New York City, meanwhile, continue to struggle. Bloomberg's learned that SoftBank plans to invest an additional $5 billion in Latin American companies. We're told the firm's board is close to approving the new capital allocation, which would double its commitment to the region to $10 billion. Sources say SoftBank will also expand investments to span from seed and Series A startup rounds to stakes in public companies. Morgan Stanley says the personal information of some of its customers with dormant stock accounts was stolen after one of its contractors was hacked. The bank said the data breach exposed names, dates of birth, and social security numbers, but not passwords. It didn't disclose how many customers were affected. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright, here in London with your Business Flash. Coming up on this programme, back to the markets. Treasuries halts an 8-day rally, though the 10-year is on course for one of its biggest weekly slides since June 2020. We'll get back to that market conversation next. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open, 52 minutes into Friday's trading session, and we are up by 1.2% on the CAC 40. So overall for Europe, up by 0.75% as we rebound a little from yesterday's losses. Ven Ram from our Markets Live team is with us. Ven, good morning. Happy Friday. It seems the losses of yesterday in part triggered by some sizable, rapid moves in Treasury markets. How do you make sense of how low we got and whether we'll go back down there again on those 10-year yields?
Morning, Anna. I think that the rally in Treasuries, to me, is looking a bit long in the tooth now, and I think it's overdone in relation to all that we know is going on about the U.S. economy, the growth outlook, and all that. Look, rates have crumbled because of two principal reasons. One is real rates, the other is term premiums. Both have declined in this quarter. Real rates have declined because of the pandemic and the effects of repeated QE, which we have discussed before. Term premiums have compressed because there is less uncertainty around the Fed's action than at least earlier before the June 16th dot plot. However, I expect yields are kind of overshooting to the downside, but I think they will eventually find better equilibrium.
Okay, so that's what we'll look for on that conversation. We've also had big news, of course, from the ECB, confirming what we had reported here at Bloomberg just yesterday about the 2% inflation target. We're seeing some lines from Governing Council member Olli Rehn this morning, and I'm still trying to understand where this policy from the ECB is the same and where it is different from the Fed. Olli Rehn saying the reaction function of the Fed and the ECB wouldn't be that far apart, but then also saying the inflation goal formulation of the ECB and the Fed are not identical. What's your sense, Ven, of how different these strategies are now?
I think President Lagarde kind of alluded to it yesterday by saying we will act forcefully to anchor inflation expectations. And I think the way they mean it to differ from the Fed's policy is by way of QE. And of course, in the euro area, we've got both the not only the asset purchase program, but the pandemic purchase program as well. And I think what they are trying to say is that, look, we are going to be markedly different from the Fed because we have got these other measures of stimulus that are going on that are well entrenched, longer entrenched than the Fed bond buying, which is in any case expected to be tapered early next year. But the key question to me is, it's great to have all these goals, the new precise goal of 2%, but it's worth keeping in mind that euro area inflation has averaged just 1.1% in the past decade and was lost about 2%, the goal, in 2018, albeit for a very short period. Now, how are they going to get to this 2% inflation goal is the key question, and I don't think we got any more clarity on that yesterday.
Okay, Ven, thank you so much. Thanks for joining us. Ven Ram from our Markets Live team. Thanks very much for joining us here on the European Market Open. Surveillance Early Edition is up next. They'll continue to take you through this market action, this rebound we're seeing in stocks. As we continue our live coverage from Venice, of course, we're live on the ground in Italy at the G20 meeting taking place there. If you have to go somewhere in the world to talk about global tax, then I can't think of many places that would be nicer to go than Venice. Looks absolutely beautiful this morning. Pressure to get that global tax deal. We'll continue our coverage on the ground there. And of course, come Sunday, it'll be that all-important football match. If you're watching, I really hope that it goes your way, whichever way your way is. If you're trying to avoid the football, I hope you have a very good weekend. I hope you have a nice weekend, whatever you're doing. And I'm off to Bloomberg Radio. This is Bloomberg.
new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling.
The deal that is on the table now, and that was agreed by 131 countries around the world through the OECD G20 inclusive framework process, is a very fair deal that will improve the system.
Bankers, young bankers who decide that they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
A lot to unpack there. Good morning and welcome to Bloomberg Surveillance Early Edition on Friday, 9th of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Taxation revolution. The world's richest nations meet in Venice, setting the stage for an overhaul of corporate taxes. We're live at the G20. Asia becomes the epicenter of market fears over a slowdown as tensions between the U.S. and China mount, and Beijing stifles its tech sector with a crackdown on big data. And coming up in the next hour, we'll be joined by the S4 Capital founder, Martin Sorrell, BlackRock Vice Chairman Philip Hildebrand, and the WHO Chief Scientist, Soumya Swaminathan. Now, the Biden administration is stepping up its condemnation of China over Xinjiang. According to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern region. This comes as China steps up its probes into domestic tech companies and clamps down on the ability for Chinese companies to list abroad. Well, joining us now to discuss all of this is Enda Curran, our Chief Asia Economics Correspondent in Hong Kong. Enda, thank you so much for being with us. First of all, is this an escalation between the U.S. and China, and is it a significant escalation?
Well, it's certainly another example of the tit-for-tat tensions that we're seeing play out ever since the Biden administration took over in January, Francine. This latest move, if it goes ahead, and we don't have the full details yet, but the idea would be that you block those U.S. companies dealing with whatever Chinese companies are on the entity list. Essentially, if you want to do business with them, you have to get permission from the Chinese government. It's one way the U.S. has been trying to exert control over its dealings with China. The other main channel, of course, being sanctions. The U.S. has also banned certain imports from Xinjiang, for example, cotton and tomatoes, and that's all about that's because the U.S. is forcefully pursuing the allegations of forced labor in Xinjiang, of course, along with the other tensions over the crackdown in Hong Kong, for example. So at the very least, you'd have to say it does add to the idea that these tensions between China and the U.S. are, if instead of going for an off-ramp, certainly continue to be on the trajectory that they were when President Biden took over back in January.
And overall, I mean, we also see this massive crackdown on Chinese technology companies. Does it fit into, a single narrative of just China trying to be much more present, much more in control of their companies and almost tolerating no dissent?
I think there's an element of, China pushing for self-reliance now. They are aware they are in these big technological crosshairs with the US. That's not going to change. So when you think about 5G or AI or semiconductors, China knows it has to get on its feet on itself a bit more, so they're going to push for tech companies to stay closer to home. They want to keep control of their own data in the same way that the US, of course, has become very wary over who controls, what foreign entities controls what consumer data. So China's firing back in that respect. And of course, it should be said that when it comes to the US pressure on China, China always rejects those criticisms from the US. They say they've got no right for interference in their own internal affairs. So China does seem to be bolstering its defenses. Its new industrial plan does speak to bolstering its own technological industries somewhat. And I think that's a theme we're seeing playing out now. Some people refer to it as decoupling. I don't think we're seeing outright decoupling between the two economies yet, but we're certainly seeing something of a schism on the technology front, that's for sure.
Enda, thank you so much. Enda Curran there, our Chief Asia Economics Correspondent in Hong Kong. Now, finance ministers and central bank governors from the G20 are meeting in Venice this weekend. Top of the agenda is the 15% global minimum corporate tax agreed at the G7. Now, the group's formal endorsement will be a key milestone after years of talks. Well, joining us now for more is our Maria Tadeo in Venice. Maria, I know the background is beautiful and it's probably nice to be back on the road. What are we actually expecting on tax?
Yes, salve, Francine. And look, this is, of course, a meeting where the focus will be very much on that OECD tax, which they say is nothing short of a revolution. You mentioned this is about the tax rate of at least 15%, but also, and perhaps even more crucially, it would give the right to countries to tax big American tech companies in the countries where they make their profits. So it could put an end to that profit shifting into low tax jurisdictions. Now, it is interesting, Francine, that we did speak with Bruno Le Maire, the French finance minister, and he said, when we look at this, this is a full package. We need to get both elements in the final deal. Of course, that is a warning to the Irish government. They argue that they could work with the tax relocation, but they cannot accept that 15%. So again, it's not a given deal that we will get to full consensus by the end of the week. Having said that, they do argue if the big 20 economies of the world do come together, that is immense pressure on countries like Ireland to shift their position.
What would this actually mean, in concrete terms, Maria, for big tech?
Well, Francine, what they argue is that, in fact, this is good news. I mean, they were expecting this. It's not a surprise. Big tech did know that the political mood had really changed, especially after Donald Trump left the White House. So they were expecting this. And what they argue, and you could argue this is to some extent spin, but they do say that they welcome the move. It's easier to deal with a global deal, with global taxation, and not go for individual countries putting forward their own digital tax. So they say they welcome the move, and it's probably going to be easier from now on to tax big tech. What critics argue, however, is that ultimately these companies are always very good at reducing their tax bills. So we're talking about 15%, but in practical terms, of course, you could argue they will try to find ways to make it smaller.
Maria, thanks so much. Maria Tadeo there in Venice. We'll get to Maria throughout the day. And Maria, I also can't wait to join you in Venice because I'm traveling this afternoon. Coming up, smart conversations on the early edition this hour. We'll talk global tax with BlackRock Vice Chair Philip Hildebrand. We'll also talk about the spread of the Delta variant with the WHO Chief Scientist Sumia Swapinathan. In the advertising opportunity of the year, the Euros final, the S4 Capital founder Martin Searle also joins us. So if you have any questions for any of our great guests, just write to us on @IB Plus TV Go. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Went up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
we need to take into account the fact that in this digital and global world, we can't have the taxation system that we had 1 century ago. So we need the big multinational to pay taxes where they are doing profits, and we need to avoid it race to the bottom, these tax havens, and have a minimal effective taxation all over the world.
That was the European Economy Commissioner, Paolo Gentiloni, speaking to Bloomberg Armenia today there at the G20 summit in Venice. Now, global tax, of course, top of the agenda at this weekend summit. We'll have plenty more from Italy throughout the show, including our interview with the BlackRock Vice Chair, Philip Hildebrand. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. A large UK study has found most young people face an extremely low risk of illness and death from COVID-19 and have no need to shield from the virus. The research found under 18s in England had about a 1 in 50,000 chance of being admitted to intensive care with coronavirus during the first year of the pandemic. Conditions that were previously thought to increase dangers like active asthma or cystic fibrosis brought a very little risk. Now, job openings in London's finance industry are almost triple the level of a year ago, ahead of the UK's exit from COVID restrictions later this month. According to data from a recruitment firm, Morgan McKinley, there were more than 3,300 jobs available at the end of last month, the highest level since January 2019. Pfizer says it will request U.S. emergency authorization in August for a 3rd booster dose of its COVID-19 vaccine. The move comes after early data shows that it can sharply increase immune protection against the coronavirus. The company has received initial data from an early human study showing that a 3rd dose of its existing vaccine is safe and can raise antibody levels by 5 to 10-fold compared with the original vaccine. And becoming an investment banker requires an enormous amount of work. That is a warning from Cantor Fitzgerald CEO Howard Lutnick. He says junior bankers complaining about long hours should rethink their choice of career in the industry.
Bankers, young bankers who decide that they're working too hard, they should choose another living. It's my view. These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young. You should know it going in and make those decisions in life. To complain about it after you got this great job, I don't know, it just seems a little silly to me.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. I'm still on the fence. I know you have to work hard for it, but it also can't be inhumane. Up next, as for Capital founder Martin Searle joins the program, we'll talk about the impediments to the global recovery. We'll talk corporate tax and maybe also a spot of football. Any questions, write to us, IB Plus TV Go. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Biden administration is stepping up its condemnation of China over Xinjiang. According to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern region. This escalation in geopolitical tensions is another hurdle for the global recovery as concerns grow about the impact of the Delta variant. Well, joining us now is Martin Searle. He's chairman of S4 Capital. Martin, thank you so much for joining us. I have a lot of questions, of course, about advertising. We'll talk about football. But first of all, do you worry that the recovery is going to be quite uneven, that it's much more difficult to see the exit out of COVID-19 if you look at China, for example, as a template?
Well, yeah, the digital economy, as far as we're concerned, the digital media economy, which last year was about $600 billion, and then you've got marketing services, 500 billion, and then trade budgets about 700-800 trillion. There's a two-speed economy there. The traditional media are under pressure and continue to be under pressure despite the bounce back. The digital economy in which S4 operates continues to develop and flower, and the pandemic, good or bad reasons, has accelerated all the trends around the digital economy. So the answer to your question, Francine, is we see no slowdown. April, May, and June, I think I've said this about 2 or 3 months ago, never in my 50 years in the business have I seen such strong organic growth. And so with relatively little inflation, at least yet, I mean, if you go back to the 1980s, which you won't remember, but I do, we had strong growth, not at these levels of 5 to 6 GDP this year and 4 to 5 next year, but we had significant inflation, so real growth was much less. So the answer to the question is we see no slowdown. April, May, and June are being extremely strong. The pipeline for July and the rest of the year are very strong. We gave market guidance, and so 35% organic growth. It will get even better than that, is my view. So it's very strong.
I mean, there are a couple of questions, Martin, that we're looking at in the markets, and I don't know whether they're sinister or they look at as some kind of downturn on growth instead of inflation, which the real economy hasn't seen yet, or whether it's just because of all the accommodative monetary policy that markets are having a bit of a wobble.
Well, you get these wobbles. Like yesterday, I had a wobble because people were worried that the growth was going to stall, as you're laying out. This morning maybe it's a little bit different. So we vary from one to the other. We have two tailwinds facing or providing growth for us. The first is GDP growth and the monetary and fiscal stimulus, which you point out, can't carry on forever. So I've said before, I'm worried about 2023, 2021, 21 and 22 strong, 23. There must be a correction and a reversion to the pre-COVID growth. That's one tailwind. The second tailwind, as far as we're concerned, is digital transformation. That doesn't slow down as a result of variations in GDP growth rates or fiscal and monetary stimulus. In the pandemic, the paradox was that digital transformation speeded up. Consumers accepted digital transformation faster. The media, as you well know at Bloomberg, speeded up faster. Streamers, the pressure on linear TV, the growth of digital outdoor, and last but not least, the change agents inside companies who were pleading for their management to change and speed up digital transformation. Q2 of last year blew a hole in profits, so people said we might as well get on with it. So you have to differentiate. When you look at our industry,
depending on where you are,
you have to look at. It's a tale of two cities, or there's a two-speed economy. Traditional under pressure, digital continues to pound forward. It will be 70% of the It will be 70% by 2026.
A lot of the focus will be on digital tax, so I don't know how much pressure you're expecting on some of these big tech giants actually going forward and what that means for the digital economy. I mean, at the margin, does it actually make a difference because their profits and revenue are so big?
Well, you have to understand that we look at the digital economy. We follow about 25 companies. I won't, in the interest of time, go through every one of them, but we look at the big 6 platforms: Google, Facebook, Amazon, Tencent, Alibaba, TikTok, and we see now other companies like Kaoshu coming through. ByteDance and TikTok has had a very strong increase in their revenues. Twitter, Snap, and Pinterest, although important, are much smaller in the digital ecosystem. But it's about Apple and Microsoft, Adobe, Oracle, and Salesforce and others. So we look at all of those. The relative merits of those and the relative strengths and weaknesses of those are not particularly important to us. What we have to do is figure out, on behalf of our clients and with our clients, how we operate in the digital ecosystem. You know, we go to market as faster, better, cheaper, agility, understanding the digital economy and doing it efficiently. Understanding the digital economy, it means about understanding the toing and froing. There will be more regulation. There is more regulation on the big tech giants, which you would expect. When companies pass $1 trillion of market cap or $2 trillion of market cap, they are as big or bigger than some nation states. And it's only natural for those nation states to start to put the pressure on, particularly when we've gone through the pandemic.
Right. What does this mean for S4 Capital? Are you going to be acquisitive? How much, you know, when you come on, we talk about how big and how ambitious you are for the group.
We are. We're at the end of the 4th month of the year, April, we were up 91%, about half organic and half through deals. And that has continued to be strong through May and June, and we say into the second half of the year. We will continue to be acquisitive. We have, I think we've signed currently about 4 exclusive LOIs. So you will see us continue the level of deal activity. I would say we will probably add a 3rd leg to our business. We're in digital advertising content. We're in data and analytics and digital media. The 3rd area will be technology services. So we will have a full end-to-end suite of services to compete against our core competition, which is really Accenture. And we will have a full suite of services. It's not really the holding companies or the specialists that we compete against. We compete against full-on against Accenture, maybe Globant as well, but they're more in the tech services area.
Martin, on the football, I know you're supporting Italy. But apart from that, does it actually?
I'm conflicted like you. I went to Germany and to Denmark, and I'll go on Sunday. And if I'm a little bit hoarse, it's because of what happened on Wednesday night.
Okay, Martin, what does it mean? I was looking at some of the audience figures. I mean, it was pretty incredible. Is football back? What does that mean for advertising if we have the sports? I mean, Tokyo's not actually having any spectators. Does it impact advertising around it?
Well, hopefully it's back and coming home. But no, look, I was talking to another network about the Olympics. I think there's, look, the TV coverage, NBC will switch their coverage to examining what happens inside homes of athletes and fans, not just in Japan, but around the world. The audiences, I had an email from a German journalist that said that the reception to the Euro 2020 or 2021 was muted. And I said, well, that was a little bit to do with performance. I think that Germany was disappointed with the performance of the German team. Obviously, it's had a very, very significant effect here. And I'm assuming in Italy, you'll find out, Francine, when you go to Venice shortly. But, you know, look, it is good
Martin,
for
your
ratings.
prediction?
These events do help the general advertising environment, particularly digital. Olympics will be really interesting this time around because the digital Olympics will flower. And then, you know, we have Paris and Los Angeles coming. We'll have Brisbane in 32. So I think the prospects for the Olympics after Tokyo and Beijing will not be easy either. It's in February of next year, the Winter Olympics. But I think the IOC is a very strong brand. 15 top sponsors, 6 of them are tech. I think there will be more tech sponsors, Alibaba heavily in there as well.
Martin,
so you'll see.
Thank you so much.
I think
I saw TikTok all over the UEFA Cup. Thank you so much, Martin Sorrell, there, chairman of S4 Capital. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Taxation revolution. The world's richest nations meet in Venice, setting the stage for an overhaul of corporate taxes. We're live at the G20. Asia becomes the epicenter of market fears over a slowdown as tensions between the US and China mount, and Beijing stifles its tech sector with a crackdown on big data. And coming up on the program, we'll be joined by the BlackRock Vice Chair, Philip Hildebrand, and then the World Health Organization Chief Scientist, Soumya Swaminathan. Well, good morning, everyone. I'm Francine Lacqua in London, and welcome to Bloomberg Surveillance Early Edition on this Friday, the 9th of July. Now, finance ministers and central bank governors from the G20 are meeting in Venice, sunny Venice. Top of the agenda is a 15% global minimum corporate tax agreed at the G7. Now, earlier this morning, the French finance minister, Bruno Le Maire, told Bloomberg that an agreement is possible.
I'm very confident, and I think that we could have, during this G20, a groundbreaking agreement on international taxation. And you know that France has been pushing for that international agreement for more than 4 years. So we are on the verge of having this agreement. It would be good news for all G20 member states. It would be also good news, I think, for the rest of the world.
Well, joining us now from the G20 in Venice is Philip Hildebrand. He's vice chair at BlackRock. Philip, thank you so much for joining us, and welcome to Venice. I know you just landed in sunny, and what a view you have behind you. You also, Philip, at BlackRock actually came out with the second-year outlook, and this in kind of the market turmoil that we saw in the last couple of days. What do you think will be the biggest pitfall for markets from here until December?
Good morning, Francine, from beautiful Venice. Look, I think the biggest risk remains COVID. We need to accelerate vaccines, administer them, and I think very importantly also think about the developing countries. Right now we're doing reasonably well, stalling somewhat. The effort has to be just to continue forcefully to administer the vaccines.
Is there a danger that actually markets are not worried about inflation, but they're worried about growth? And if you look at China and if you look at other parts of the world, we should worry more about what kind of recovery we will see than currently priced in?
I think if you look at the developed world, I'm convinced we have a restart. It's real, it's powerful, and it's rapid. In fact, looking at the U.S. economy, it looks to me as strong as it's been in decades, frankly, generations. So I'm not worried about growth. I think we're going to see very, very strong growth numbers. We are also going to move into a higher inflation regime. The collaboration between monetary and fiscal policy that has allowed us to bridge COVID will lead us into a higher inflation regime. It will take some time to settle, so I don't think we should pay too much attention to the very short-term numbers. But inflation will move higher as we kind of go through this transition phase.
What's the most surprising thing when you look at the mid-year outlook and you're really looking beyond the restart and maybe some of the legacy of COVID and how our economies will differ? What surprised you the most in this, Philip?
Well, I think we have an unusually wide range of views right now, both frankly internally at BlackRock amongst our portfolio managers, but you can also see that across the market. So, that leads to the market is looking for which of these outcomes turns out to be the most likely one, and so we should expect to see some volatility as we move forward. I think the biggest issue, the biggest longer-term question is, can we get through this restart? Can we implement these no monetary policy regimes that have been adopted by the major central banks without unhinging long-term inflation expectations? That will be, over the next 3 years, let's say, the most important challenge the central banks will face. And as we proceed into this restart, the market will begin to focus on that.
And Philip, you basically suggested there's a wide range of potential outcomes. Again, if you go back to the markets and what we've been seeing in bonds over the last couple of days, does it mean that, a lot of people can make money but also lose money quite quickly, given how markets are priced right now, that bonds are going one way or telling us one thing and the rest of the market something else?
I think because we have a wide range of potential outcomes longer term, it's going to be very hard to time the market in a short-term trading kind of sense. This is what happens when the market is trying to calibrate itself and look for the right path. There's going to be a lot of movement back and forth, as we've seen. So I think that the most sensible thing to do is to not pay too much attention to the very short term, to the 24-hour news cycle, and really focus on the big story. And right now, that will be the restart. I think we're going to see some easing signals coming out of China. That's a very important macro signal. And then, as I said, longer term, the big question will be, can we pull this off without unhinging or undermining long-term inflation expectations?
What does China actually mean for BlackRock? Is it an investment destination, or do you worry about some of what we've heard this week, which is a crackdown, for example, on technology, but also the kind of reversal that you were talking about that PBOC has done to support the economy?
Yes, China is a very important part of the story. It's a huge part of the global economy. Most investors are under-allocated to China. If you think about the long-term allocation, that long-term allocation will go up. It's inevitable as China represents such a big weight. At the same time, there's a risk premium attached to some of the strategic tensions between the U.S. and China, as well as some of the issues around the tech sector, the interference of the state in the marketplace, in the economy. And we have seen these recent slowdown signals, which again I think will now lead to an easing of policy, which will be a very significant development on the macro side. So I think these announcements the last few days coming out of China are actually potentially more important or equally important as some of the tensions we've seen around the Chinese tech companies.
Philip, do you worry? I mean, if you look at U.S.-China tensions, I don't know whether that's less worrying than some of the global supply chain issues or access to chips that we've seen, and whether that is probably the biggest risk for the economy, and again, what that translates into for central banks.
It's a tension point, undoubtedly. It's a risk factor. At the same time, you know, these economies now are so integrated. When you compare this to the Cold War, where we had equal sort of tensions between the Soviet Union and the United States, at the time, the Soviet Union was a fraction of what China represents in the global economy. So both sides have an inherent and profound interest to manage these tensions. They will be with us for a long time, perhaps for a generation, but you have to believe that they can be managed and will be managed simply because there's so much at stake. There's such a deep degree of economic integration now between these two economies, and China is very big. China is a big part of the global economy, much bigger than the Soviet Union ever was, even during the height of the Cold War. So I think it's a different setup. It is a risk, and investors will take that into account as they look to increase the allocation to China in the long term. Again, if you just look at the facts today, there's no doubt that investors are, broadly speaking, under-allocated to China from a diversified portfolio perspective.
How are you feeling about Europe right now? And I want to ask you a little bit about, Philip, the European banks, but in general, is the European economy holding okay? It doesn't have enough, or it doesn't have as much stimulus as the U.S., and we have some very important elections coming up later this year.
I think the economy looks good to me. It's going to be strong. We're going to see the same restart dynamic that we're seeing in the U.S. It's lagging a little bit. The vaccinations are running behind a bit. But essentially, it's going to be the same story. I think there are some very positive developments in Europe. The recovery fund is a powerful vehicle. If you look at the sums of money that will be invested in countries like Spain, Greece, and Italy, these are extraordinary opportunities to change the path of longer-term growth in these countries. And I think that's the real historic opportunity that Europe now has for the first time in a long time, thanks to the public sector, thanks to the policy response during COVID. We're going to have the ability to see huge investments being made from the public sector, hopefully also incentivizing private capital to move. So I think there is a story here that looks very attractive for Europe, provided, and this is the key point, that these public funds are invested in a way that enhance long-term growth potential and enhance long-term productivity potential in the European economy. But I remain, frankly speaking, quite optimistic as far as Europe goes in these, as the months proceed and as the restart proceeds.
Philip, is it at the start of or mid-2022 that we'll see whether there's finally appetite for cross-border, banking consolidation in Europe?
Well, look, this is a topic you and I have discussed for years, unfortunately. There is not going to be a better time than this restart period, let's say the next 18 months for the European authorities to really complete banking union. There is going to be no better window than now. We're going to see very strong growth numbers. We're going to see, a moderate response, if any, from the central bank, even if inflation will rise, which is what I would expect. So this is, in a way, going to be almost a sweet spot for completing the unfinished business around banking union. And once you have that in place, if the recovery continues, and if we do see some pickup in potential growth beyond the restart, then I think it could become very interesting for the banks to look at growth opportunities. They have been in retrenchment mode for years now. They've been in business model repair mode. It is time to get back into growth mode at some point over the next couple of years. This is the window to do that.
Philip, when you look at the new strategic review, actually from the ECB yesterday, how much of a game changer is it for the economy, but especially for the market? So, you know, the ECB president will have a communication challenge on July the 22nd, but does it actually mean that they could be much more accommodative for longer, or is it still all to play?
I think what came out to me looks very sensible, and frankly, we should commend the president for having done this in the way she did, in getting full consensus behind these deliberations. These are difficult moments for a central bank, and the last thing you need is divisions within the council. She managed to do this, I thought, very effectively. The outcome to me is sensible. It's a bit more cautious than the Federal Reserve's new framework, so it doesn't have an explicit kind of make-up strategy dimension, which again I think is sensible given the European history and the European sensitivities, as well as the mandate of the central bank. At the margin, it gives more room. But I think at any rate, we have to assume that the policy response is going to be very muted going forward relative to what history would suggest when you look at where inflation is going to go. And that's true for the U.S., certainly, very much true for the U.S., but I think it'll be true also for the ECB. And the new framework at the margin could contribute to that, but I don't think it changes the path fundamentally. It re-emphasizes that they will not make the mistake the ECB made in 2011. That's for sure.
Philip, thank you so much. Philip Hildebrand. I mean, Venice is so beautiful. I can hear the cicadas, Philip, and at the same time, I can also hear helicopter landings. So I don't know whether that's Janet Yellen or Larry Fink. I hope you'll report back. Philip Hildebrand, vice chair there at BlackRock. Now, coming up, as the coronavirus continues its resurgence with the rapid spread of the Delta variant, we speak to the chief scientist of the World Health Organization, Soumya Swaminathan. That's coming up next, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, coronavirus continues its resurgence across the world with the rapid spread of the Delta variant. India has approved a $2.3 billion response fund to fight the country's devastating second wave. At the same time, Indonesia is receiving aid to help meet a shortfall of oxygen supplies amid a surge in hospitalizations. Now, in Korea, the government is raising curbs on social distancing to their highest level. Well, joining us now is Dr. Soumya Swaminathan, the WHO chief scientist. Thank you so much, Doctor, for joining us for this really important conversation. First of all, do you think, Doctor, that the evolution of COVID has slowed?
I wouldn't say that at all. What we're seeing now is, of course, a diverging pandemic or a dual pandemic. There are parts of the world where vaccination coverage has reached the point where there is a slowdown, certainly of severe cases and people being ill enough to be hospitalized. But there are large parts of the world, and you were just naming a few countries where there are surges, where there's oxygen shortages, where there's a lack of beds and increasing mortality. In the last 24 hours, we've had close to 500,000 new cases being reported and about 9,300 deaths. Now, that's not a pandemic that's slowing down. Yeah. In fact, in 5 of the 6 WHO regions, cases are rising. And mortality in the African continent has gone up by about 30 to 40% in the last 2 weeks.
Yeah. Doctor, have you seen any new variants that could have resulted with, us vaccinating populations whilst cases are going up?
So, there are several reasons for why this is happening. Why are globally cases going up and why are so many countries seeing a steep rise in cases? And I should add that these include countries that have unvaccinated populations and countries that have vaccinated 30, 40, or 50% of their population. So the reasons are the Delta variant is certainly the most transmissible, the most dangerous variant of the virus that we have seen so far. In fact, the original virus, if one infected person could spread it to 2 or 3 people, this variant, the Delta variant, one infected person can infect 8 people. They're also infectious for longer. So that's the first reason. The second is increased social mixing, what's called pandemic fatigue. People are getting back to their normal lives, either by compulsion because of economic reasons or otherwise. And third is the relaxation of public health and social measures. We've seen many countries and sub-regions and countries dropping all of the measures, including masking and physical distancing. And the fourth is the slow pace of vaccination globally. So these are the things that are contributing to the rise in cases that we're seeing over the last 2 to 3 weeks.
But is it likely that we'll see new variants in the coming months or quarters?
It's quite possible. We cannot predict, but the virus is evolving and mutating all the time. So we're already seeing within the known, like within Alpha and within Delta, we're seeing additional mutations, which can be quite dangerous. They could confer properties where the virus actually becomes even more resistant to vaccines. So, of course, the worst case scenario is that the virus becomes resistant to the existing vaccines, which has not happened so far. There's been some impact on the vaccine efficacy, but most of the vaccines that are being used are still highly efficacious against severe disease. But this is something we cannot predict. So it's really a race between getting our populations covered through vaccination and maintaining the measures till then to prevent the surge in cases. Because we know that the more the transmission that's happening, the more easily the virus can only mutate when it's actively multiplying and transmitting. So that's the way to stop further variants from arising.
Doctor, do we need boosters actually in the fall? And how do developed nations square that with only 10% of the developing nations even having gone through their first shot?
As you rightly said, we at the WHO are focused on trying to get 10% of every country's population vaccinated and protected by the end of September. That's within the next 90 days, and 40% by the end of the year in every country. We don't want to see some countries with, getting close to 70, 80%, and somewhere not even 2%, not even the frontline workers are vaccinated. The need for boosters, depends on the science, and the science, of course, is evolving. What is encouraging is that many studies now are showing that immunity seems to last quite long after a course of vaccination. It seems to last for 8 months. There are some data now up to 12 months where people have been followed up in the vaccine trials, and you have both the antibody responses as well as what we call the cell-mediated or T-cell responses. So it does appear that immunity could be long-lasting and that we may not need a yearly booster. On the other hand, there may be subgroups of people, the elderly, for example, or those who have other underlying diseases, immunosuppressed people who cannot mount a good immune response, who may need more frequent boosters. And there are going to be now studies, I think, happening to look at what happens over a period of time, both in people who do not receive a booster and perhaps in some who do. So again, there's no clear evidence at this point that we're all going to need boosters, which is a very good thing. But right now the focus is let's get people vaccinated, those who haven't had their first course.
How do you feel about governments actually offering rewards for people to get vaccinated? Is that a slippery slope?
Well, again, you know, it makes me sad because there are countries where people are waiting, are really dying, in fact, are waiting for the vaccines. And there are other countries where people are being given all sorts of incentives and gifts. We're not against that in the sense that you have to do what you need to do to get that vaccine coverage rates up, because that's what's going to reduce transmission, really bring this virus down where it's not having an impact on society. But, you know, we need to understand what's driving either a lack of enthusiasm or hesitancy. In some cases, it's just practical things like, you know, just getting vaccines close to people, making it easier, getting friends or relatives or a helper to come and help you if you're not able to go yourself to the vaccine center, providing that additional bit of information, answering the questions that people might have. In many cases, I think it's those things, and it varies from, you know, place to place. It's very contextual. We know that there is vaccine hesitancy, there are conspiracy theories, etc. But the majority of people, I think they have some questions that need to be answered, and perhaps some incentives, some practical things that make them, you know, come forward. But again, there are large populations that are waiting to get vaccines, and so that's where then we start seeing these inequities.
Thank you so much for this conversation. Soumya Swaminathan there, the WHO chief scientist, joining us this morning on variants and COVID. Coming up, we'll get back to the markets after Jens Weidmann softens the tone of the ECB's strategy review. That's coming up next, and this is Bloomberg.
every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. A lot of the focus, of course, is on the markets. We had a good conversation with Philip Hildebrand about what exactly he's seeing in the markets. U.S. equity futures pretty much steady. Treasuries halting an 8-day rally. And then if you look at Europe, they're kind of gaining. The big one to watch out for is, of course, the 10-year German bond. And you can see they're practically unchanged after the ECB review yesterday. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
If it now is the case that the marginal rate of recovery is going to be weaker than what everybody's forecasting, the markets are going to adjust.
For better or worse, we might not get clarity around that growth picture until later in the summer, September, that we're into a period where some of the data may be a little bit mixed until we see more clarity a little bit later on in the year.
The market is treating the hawkish noises from the Fed as essentially a policy mistake.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, July the 9th. Our top stories today. Blacklisted, more Chinese entities reportedly will be barred from doing business with American companies because of Beijing's alleged human rights violation. The G20 gets on board. Finance ministers from the biggest economies are set to endorse a landmark global tax overhaul. And still betting on bonds while treasuries end an 8-day rally, and some of the world's biggest money managers say there will be a swift comeback for the battered reflation trades. So good morning, everyone. I'm Francine Lackwith, Matt Miller and Danny Berger. Katie Lyons is off this week. Matt, there was quite a lot going on in the markets this week. So as we kind of round off the weekend this Friday, we look at what we heard from the ECB strategy review. Didn't make much of a difference, but they may have a communication concern coming up on July the 22nd. And then the other focus, of course, still, yet again, inflation, growth, and the reflation trade.
Yeah, it seems like things are kind of on autopilot here in terms of the ECB. They can raise their inflation target if they want, but they're still terribly unlikely to hit it. And they do have Jens Weidmann at the Bundesbank saying they're not going to push for higher inflation than 2%. Take a look at what's going on in Asian markets overnight. There was no soccer, so we're all fresh this morning and ready to rock and roll, but nonetheless, we see a lot of selling going on in Asia. It's not the huge drops that you may be concerned about, but if you look at the MSCI Asia Pacific Index over a year-to-date period, we briefly lost gains. So really not doing well compared to other regions where we're almost at highs in Europe, at record highs in the U.S. minus yesterday. You can see Tencent bounce back a little bit, up 2%, actually adding the most points to the MSCI Asia Pacific Index. Alibaba is still down, but not a big drop, 0.9%. It is obviously a very big company, so that makes a difference on the index. And I noticed that, you know, the Bloomberg Dollar Index, not moving very much, but the dollar is stronger against the yen, it's stronger against the euro, and stronger against the pound. So maybe getting a little bit of strength back against some of these currencies.
Yeah, Matt, it does kind of seem like the only place that you still have kind of that risk aversion is in Asian equities, because, I mean, look what's happening here in Europe. It's the opposite of what we saw yesterday. We're clawing back at some of those losses. You have France, for example, one of the best performers, up 1.7%. You have UK stocks up 0.8%, despite the fact we got growth figures out of the UK today that showed that rate of change that everybody's concerned about is slowing when it comes to the GDP figures. At least wasn't as fast as many people had expected. But on a headline level, we are higher today in Europe by 2.5%. Again, this is at least when it comes to travel and leisure. Now, this is kind of my proof here that we're reversing some of yesterday's, because travel and leisure and basic resources, the two best performing sectors in the stock 600. This is a very cyclical type trade if that's what you're going to go in and buy today. So dip buying to end your week, making everybody happy, of course. We do have a German 10-year bond yield that's at negative 31 basis points. We have a lot of ECB speakers, a lot of comments coming after that strategic review. And finally, a euro dollar that's weaker today. We have the dollar slightly higher. As you pointed out, Matt, it was higher versus the yen as well. So that taking shape with the policy divergence in the U.S. versus the rest of the world. Here we have the U.S. You have a 10-year yield again coming back. Are the shorts mostly washed out? A lot of the people we've been speaking to say no, they are not totally washed out. But with the yield moving higher, really dictating the move in the stock market, you have S&P futures and NASDAQ futures moving higher in your pre-market session, though NASDAQ a little bit weaker. Again, it's not really growth. It is more of a value type cyclical day. And then finally, break evens. They are moving lower. This is the real standout here. So even if we're taking a break in this sort of risk off type atmosphere, Francine, you still have break evens that are their lowest in a couple months. I think this is about its lowest since March. So there are still fears about the economy, about whether reflation can come back. So sure, maybe you want to trade the reflation trade in stocks, but it fears that this picture isn't going to pick up is still rife within markets.
Yeah, but Danny, that's the one thing that we're trying to figure out, of course, and exactly what's priced in. Also, look ahead at what's going on today. So we start with G20 Finance Ministers, central bankers meeting in Venice Italy today. It's the G20's latest self-imposed deadline to wrap up global minimum tax talks following the recent endorsement by 130 nations of setting a minimum tax rate for corporations. U.S. Treasury Secretary Janet Yellen will also be in attendance. After that, she makes her way to Brussels for meetings with the Eurogroup. And then coming up in just under an hour's time, the ECB President Christine Lagarde and the BOE Governor Andrew Bailey appear on a panel discussion about digitalization as part of the annual conference of the Global Forum on Productivity. And then data to round off the week coming up at 10 a.m. New York time will, of course, get U.S. wholesale inventories. Now, back to geopolitics, and the Biden administration is stepping up its condemnation of China over Xinjiang. Now, according to a report, the U.S. will add at least 10 Chinese entities to its economic blacklist as early as today over alleged human rights abuses in the northern regions. Bloomberg's chief Asia economics correspondent, Enda Curran, now joins us. Enda, is this just a tit for tat, or is this a turn for the worse?
It's another escalation in the tensions between the US and China, Francine. If you're put on this entity list, that means that US companies cannot deal with these Chinese counterparts without permission from the US government. It's one of the tools the US is using against China, along with sanctions. They've already put bans on imports of certain goods from Xinjiang, such as cotton. This is all about US criticism of China's human rights policies. China, of course, has pushed back. Before I came on air, they again rejected the US allegations against Xinjiang, and of course it's cracked down in Hong Kong. But at the very least, it speaks to ongoing tensions between the world's two biggest economies.
And another concern in China at the moment is the data, whether growth is still on track. We had PPI numbers out today. Do we have any more of a clear picture at this point?
We are getting a hint that China's economy is slowing down. Like you mentioned, their PPI is cooling. It was at a 13-year high. It's now coming off on the back of a strong dollar and, of course, some government measures to take the heat off commodity prices. That will be welcomed by manufacturers. They have been juggling with very high input prices, but we'll get a much better picture next week. We get second quarter GDP data at the end of next week, along with figures for retail sales, and that will give us a fuller picture in terms of what's happening with China's recovery. Is it broadly on track, or is it cooling quicker than expected?
All right, very interesting, especially as both countries start to really focus in on data privacy. To be fair, the Trump administration was pretty focused on this from the U.S. side last year, and now China seems to be seriously concerned about sharing its big data, big tech companies' data. Bloomberg's Enda Curran there. Thanks very much. Let's turn to Venice, where finance ministers and central bank governors from the G20 are meeting. Top of the agenda is the 15% global minimum corporate tax, agreed for the most part at the G7. French Finance Minister Bruno Le Maire spoke to Bloomberg early this morning about his plans.
Let's be very clear. For France, we aim at having more than 15% for the minimum taxation. I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century.
That was French Finance Minister Bruno Le Maire speaking to Bloomberg's Maria Tadeo. Maria joins us now from Venice. So, Maria, what are we expecting on the tax, minimum tax this morning or this meeting? Are they going to be able to bring it over the line?
Yes, ciao tutti. And, Matt, to that question, on paper, everyone will tell you we're confident we're going to get a deal. But the reality is, behind the scenes, when you speak to ministers here, this is a very complicated story, Matt. On the one hand, the French would tell you 15% is good, but we want to take that higher. Keep in mind, there's no deal yet around the 15%. Then you also have the Irish who say we could work with relocating taxes to the countries where services are provided, but we cannot sign on to that 15%. And then also playing in the background here is the fact that the Europeans are also pushing forward their own EU digital tax next week. For the Americans, this is very difficult to understand. They argue we're now finally getting to an OECD deal, we're getting to a G20 deal, and you guys are still going your own way. So yes, on paper, they'll tell you we're confident come Sunday, we're getting a deal on this. This is a tax revolution. But actually, if you look through the cracks here, there is still a lot pending and a lot of question marks.
Maria, when you look at what exactly this means for some of the big tech companies, I mean, could they hurt, or is it actually postponed in the future?
Well, Francine, what they argue is that to some extent they were ready for this moment. This doesn't really come as a surprise. There has been a change in the global conversation around taxes. There has been a political change too, especially in the United States. So they were to some extent ready for this moment to have to pay more, and we are going to see them pay more to that extent where you move perhaps from 12% to 15%. What they argue is that in fact they welcome this move because it could make things less complicated for them. They preferred to pay one single tax across the world and not many different jurisdictions doing their own thing. Having said that, Francine, critics do say ultimately these companies are very smart. They know how to play the game. Whether they pay or not, 15% effective tax rate remains to be seen. They always find a way to reduce that tax bill.
Maria, thank you so much. And thank you so much for bringing us those beautiful scenes in Venice. What a great backdrop. Now I have very intense FOMO for the rest of the day. What can you do? Anyway, earlier in the show, I talked about how you have this kind of risk-on, more cyclical, even reopening play doing pretty strongly so far. Pre-market, the stocks that are moving to the upside certainly reflect that. Carnival up 2.5%. It's also trading higher in its London-listed stock as well. So this is a sign that people want to go in and buy the dip after yesterday's pretty big fall. I want to give us a check on some of the Chinese ADRs in the U.S. as well, because of course, they've had a very volatile week. DD actually up more than 4.5% so far pre-market. Look, it's still down 20% since it IPO'd last week, so it's not like this is all clear, but maybe at just above $11, it's finally attractive for people to go back in and buy as we kind of wait to see what the political ramifications are between the US and China at the moment. And guys, I had to do this as my last stock. I'm sorry, I guess. You're welcome, I guess. But I did C-Pop, Chinese hip-hop company. I still don't totally understand what they do or why it has the moves they do. But just to recap, this is a Chinese company listed in the U.S. that for some reason never moves like the other ones that we've seen. Currently down 3% pre-market. But I should say, Francine, it's still up 200% since it IPO'd last week.
Yeah, I mean, I wonder whether they consider it a data company, and so sometimes it just gets kind of like bought with the other ones that they're, trying to crack down on, such as DD. So we'll dig into it a little bit deeper. Definitely the story of the week. Coming up, we talk inflation, markets, and growth. With Christian Nolting, Deutsche Bank International Private Bank Chief Investment Officer. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller, Francine Lacqua, and Danny Berger. Kaylee Lines is off this week. We have breaking news out of China. They have cut their reserve ratio by 0.5 percentage point. Not entirely unexpected, but one more move to help goose the economy as they make some other moves that maybe sap growth a bit. Take a look at this chart that Danny Berger threw together this morning. We see data increasingly disappoint. Not this chart. That's the Chinese yuan cross rate with the U.S. dollar. It's another chart, 914. I have it here in the terminal next to me. And, oh, it's there in the giant terminal as well. So it's on a number of different screens. You can get it by typing G #BTV914. This shows the City Economic Surprise Index for the U.S. in blue and for China in white. For those of you listening on Bloomberg Radio, I'll translate for you. The U.S. Economic Surprise Index has come down pretty substantially, but not nearly as much as the China Surprise Index, which is back down into negative territory and has been there for a number of months. Joining us from Frankfurt is Christian Nolting, CIO and Head of Investment Solutions at Deutsche Bank International Private Bank. Christian, the reason I bring this up is that we've heard from a number of people, including yesterday Jim O'Neill told Francine, that maybe China is behind the risk-averse market behavior we've seen over the past few days, especially the increasing search for safety in treasuries. How do you view it?
Yeah, first of all, I think it doesn't really come as a surprise, the reserve ratio cut. There was rumors in the market. And if you look indeed at Chinese growth, so we are forecasting quite a decent number this year, but only 5.5 next year. So the discussion also, I think, in recent days in the market was, are we beyond or below the peak growth now? So are growth numbers coming down from here? So I think it's rather positive that China is acting on this, because there was also some discussion, are the central banks now only talking about tapering, and the central bank now again supporting the market, I think is really positive news. But we need to live with that reality, right? So they get a boost in growth, but from there onwards, we probably see lower growth rates. And that's the first reaction we see to that, which I think is a positive one.
Christian, overall, is China the big unknown? So is this why we're seeing quite a lot of movement on treasuries, that we don't exactly know the way forward, the right way to exit, for example, COVID-19, given the pressures on growth we're seeing now in China?
Well, I think there's a lot of, let's say, focus on Chinese markets with the good performance we've seen before. So this year, equity markets are slightly down, right? Then economy, I think, was the first to come out with decent growth, then lower growth going forward. Then the tensions between US-China, I think, won't go away very quickly. There was some hope on the Biden, let's say, government to change this, but literally they won't. Why should they? So I think that will stay. So there will be a continuous focus, as China always is, maybe one step ahead, and that could be to the upside, but also to the downside. And that's why that's what we see, and that's to be expected from my point of view.
So in that downside we've seen, how do you take into account equities being so tied to lower yields? Why are lower yields causing the destruction? I mean, hasn't the argument from equity bulls long been that when treasuries are more expensive, all of a sudden stocks are more attractive? What's going on with the link between the two?
Yeah, I think an interesting link to watch is really break-even inflation and equities. So it's a lot about inflation expectations and a lot about, let's say, opening of the markets and equities pricing that in. I think undoubtedly we will stay in a very low, let's say, interest rate environment for quite some time. But again, if you check break-even inflations and the S&P, for example, there was a kind of, not perfect, but a very high correlation. So from that perspective, I think that's where markets are going. So if the discussion is that inflation expectations are not going through the roof, then you see that, let's say, move in equities as well, realizing it's probably not a one-way street out of this crisis.
Christian, thanks so much. Christian Nolting, their Chief Investment Officer and Head of Investment Solutions at Deutsche Bank International Private Bank. Now, coming up a little bit later, Mohamed El-Arian, Gramercy Funds Management Chair and Bloomberg Opinion columnist. So that interview, 9 a.m. in New York, 2 p.m. in London, and this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg's.
Hello, traders.
Mornings on Bloomberg.
How are you doing today? Back to business. We're going to place an order to buy euro. The price I'm looking to buy 118,347. Okay. If you're looking to trade today, and if you want to trade euro, here is your chance. G20 started, by the way, so here is the chance that euro will be volatile these days. So order placed at 118,348. We need 346. Yeah, okay. Let's put 346. Okay, order placed at 118,346. Let's see how long it will take, and if we will take, let's place even, okay, yeah, 346. Are we able right now, or it's quite large order, so it probably will take a while to get filled. Okay, yep, position opened even at 118. No, 346. Okay, all of you guys who decided to trade euro, well done. You still have a chance because it moved lower, so you still have a chance to enter position. And stay with me. You copied this trade, so stay with me until the end. You can use your own broker. You don't have to choose any other brokers. If you want to get the strategy to find out how we trade, you can go to company.co.uk and you will get the strategy from there. We also will provide webinar for you. So if you want to register for webinar on 17th of July, please do so. So I will show you everything, how to do arbitrage, how to use our strategy, what brokers and what kind of questions you need to ask in order to choose the right broker that will be good for the strategy we're using. Okay, because we're selling short, we're buying. Some brokerage firms will not allow you to trade on margin. So all these things I will explain during the webinar. I'll speak to you later, guys.
These are hard jobs. You want to be a doctor, you're going to work hard when you're young. You want to be a banker, you're going to work really hard when you're young. You should know it going in and make those decisions in life. To complain about it after you got this great job, I don't know, just seems a little silly to me.
Matt Miller has been saying this all along. Matt, I don't disagree. It just depends on whether, you know, it's long hours or it's actually humiliation in doing the hours. So I think it goes back to the culture. And so it's difficult. I would look at it on a case-by-case
I don't think anyone
basis,
disagrees.
But, you know, me, I'm a softie.
Everybody,
I mean, it doesn't matter how much you're getting paid, though. You shouldn't be depressed, right? Like, I feel like mental health.
Well, okay. Here's the thing. I think we all agree with what Howard Lutnick says, but we don't want to say it publicly because, you know, we take mental health seriously. It's very politically correct to kind of tiptoe around these issues. But come on, I mean, if you're going to make millions of dollars a year later in life, you got to put in some hard work now. That's just how it goes.
Yeah,
Nobody gets
Matt,
to be a partner at Goldman Sachs for free.
Of course. I mean, there's like, there's mental abuse and there's hard work, which is why I would say it on a case-by-case basis. Again, we're in lockdown. If you're asked to work like 22 hours out of 24, that's inhumane. If you're being asked, to work 15 hours, that's different. So I'm a very much depends on the case kind of gal.
Not going to get this without competition and hard work. That's just how it goes. And otherwise, you could do something better for the world. Maybe go be a teacher. That would be nice. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more, they might just need just some practical experience in an Australian kitchen.
I have not from Australian friend, now back in the kitchen I have many friends.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition of Francine Lack with Matt Miller and Danny Berger. Kaylee Lines is off today. Matt, the focus, of course, on inflation growth and then the latest news on China.
Yeah, absolutely. I mean, it's really interesting how the market's perception of future growth seemed to change overnight. Obviously, it wasn't overnight. We've seen bond yields coming down for days and days and days. But all of a sudden yesterday, it seemed like growth fears was the phrase du jour. And the China issue, I think, is really complicated and fascinating. Not only are we watching the data, the economic data coming out of China, it's very important, but we're also watching the data, big data, very closely, like who controls the data from Didi, who controls the data from TikTok, and what can you possibly do with that? A lot of great reporting coming out of Bloomberg over the last 24 hours on this.
Yeah, and that, of course, is playing out in the markets, Danny.
Yeah, I mean, look, we are taking a breather here of the intense risk off we saw yesterday. Sebastian Gailey over at Nordea says, look, this is just that. It's just a breather that in order for the markets to really be able to sustain some more growth in the equity picture, we need to see that. We need to see better economic numbers. So far, we are seeing havens. They're not as interesting today. You have a dollar gaining against the Japanese yen. You have a U.S. 10-year yield, which is moving about 4 basis points higher. It's at 133.44. S&P futures not doing as well as Russell 2000 futures. So again, it's a very cyclical risk-on type of day if you have small caps outperforming up by 1.2%. Now, some of the individual stocks moving, if we're going to be feeling bad for billionaires, poor Steve Ballmer slipped a little bit in his wealth yesterday after Microsoft fell. Well, it's time maybe not to feel as great for Virgin Galactic because Richard Branson is going into space, and pre-market the stock is only up 0.3%. I mean, look, granted, it's been up 20% since it was announced, but still, we're not as excited today in this stock as we had been.
It's
General
high risk.
Motors here, it is high, and it's a meme stock too. I will have you know, so that's tied to it as well. General Motors, first they have an upgrade from Wedbush over their EV strategy. Also a little bit of politics going into this. The U.S. and Mexico reaching a new agreement over one of GM's plants in Mexico over some U.S. concerns over workers' rights. And finally, Stellantis up 2.3% pre-market. They had their electric vehicle day yesterday. They're spending 30 billion euros. Matt, I know you want to get your hands on an electric Dodge, but you can't get the muscle car until 2024. And can I also just say, if they don't call it a charger, they are fools. It is right there for them. It must be an electric charger. I mean, it's perfect, right?
You are so right. I absolutely loved their presentations yesterday. Muscle cars make sense because obviously you get instant torque with the electric power, and the designs are going to be classic 60s muscle. I'm super excited, but yeah, 2024 is the first time we're going to be able to get those.
The sound won't be there.
That's a good point.
No
That's
sound.
a good point. They won't sound very good. It's a loss for the kids. The kids are never going to know how good we had it back in the day. Poor kids.
Yeah, the poor kids. We're trying to save their planet, but poor kids. Now, let's get more on that. Breaking news out of China. And China's central bank is cutting the amount of cash most banks must hold in reserve in order to boost lending in the economy. Bloomberg's chief Asia economics correspondent, Enda Kern, joins us now with the very latest. Enda, does this actually fit in the pattern of, you know, the authorities have this, they'll tweak around the edges, but they're trying to make sure that there's, you know, that there's nothing ugly out there in the Chinese economy?
Well, it is something of a surprise, Francine. The government did signal earlier this week that they think there are parts of the economy that need support. And now today, the PBOC has come out with this cut of 50 basis points to what's called a reserve ratio requirement. In essence, that frees up money among banks to lend into the parts of the economy that need it most. So, to be clear, the PBOC said in its statement it's not a broad-based easing. They're not about to reverse course. They're still talking about what they say is prudent monetary policy. But I think it does say, Francine, as you mentioned, it does speak to the idea that there are some concerns now over some slowing in China's economy. And certainly there's been evidence recently that China's rebound has gone from a kind of a red-hot pace to something much more of a stable output from here.
I read overnight the Didi crackdown story about China wanting to control big data. I have to say, and it is absolutely fascinating, and to me it also makes perfect sense. I hadn't realized that somebody had published the Didi data showing politicians moving around certain government ministries, and there's just so much you could do with this big data. Obviously, you don't want it falling in the wrong hands. What are we going to see on this going forward?
Well, this is at the center of tensions now, Matt, between the US and China. Technology is front and center, whether it's 5G, whether it's semiconductors, or whether it's developing any of the other kind of know-how that China needs to develop its economy from here. They are starting to get on their own feet a bit more now. They realize the US is trying to isolate them a little bit on this front. Data protection is at the center of that as well. Of course, we know the US had concerns last year over TikTok, and now China's pushing that boat too with its own concerns over where Didi's data goes. None of these tensions are going to go away. The end result does seem to be, though, that China is trying to bring its tech companies back closer to home, to bring them back underneath the dragnet of its central government. That could mean more companies listing in Shanghai and Hong Kong rather than going to New York. And I think this idea of
of tech decoupling between the world's two biggest economies still has a way to go, has a way to run yet, Matt. And in fact, if anything, it might spill over from technology to other parts of the economies too.
Thanks so much, Enda. As Matt says, it's all about the data, whether tech data or economic data. That's Bloomberg's Enda Curran. Now, coming up, Frederic Decrozet, Pictet Wealth Management Global Strategist. We're going to speak with him about some of the volatility that we've been seeing in markets. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Francine Lacqua and Danny Berger. Kaylee Lines is off today. Now, we have been looking at yields falling lower and lower and lower throughout the last, I guess, 8 sessions. Is it 8 sessions in a row, Danny? I'm pretty sure that it is. Danny threw together a chart for me. It's 8,400. I don't see it here. There it is. U.S. real yields continue to sink further as well. Tom will often pull up real yields. The ticker is T10Y, I should say. Essentially, these are tips, and we came down below -1% yesterday. For our listeners on London DAB Digital Radio, I'll just tell you that I'm showing tips right now for 10 years, 5 years, and 2 years, and they're all way below zero, with the 2 years down at -2.5%, almost. Joining us now is Frederic Decrozet, Global Strategist at Pictet Wealth Management. And Frederic, I just wonder what this says about the market's expectations for growth and inflation 2 years, 5 years, 10 years down the road. Is it right to look at it that way?
Absolutely. I mean, at least there is a debate raging at the moment whether this decline in long-term yields is mostly fundamentals driven. So as you said, expectations of lower growth, lower inflation, perhaps some obstacles to Fed tightening, let alone normalization in policy rates, so a challenge to the Fed's view, or whether it's mostly technicals driven, because that's also something that has played an important role in the bond market over the past quarter, at least. As a reminder, it's the first time that the Fed bought more US treasuries that the government in the US actually issued on a net basis. So that was the first time, a support for the bonds, low yields, and it might change in the second half. We'll see. There's a lot of liquidity events happening. The bond market in the US tends to perhaps exaggerate the moves from time to time, and there are good reasons to believe that this growth outlook remains solid over the longer term. So maybe the move is a bit overdone, but I'm careful now with the very short-term outlook in the bond market. Things can move fast.
Frédéric, why did actually the ECB in the strategic review didn't go as far as what the Fed in terms of the inflation targeting?
That's a good question. That's really the uncomfortable impression I'm left with today, the day after the strategy review, to be honest, because it was absolutely crystal clear. Yesterday with Christine Lagarde, she said the Fed, the ECB is not doing a flexible average inflation targeting a la Fed. And this morning, if it wasn't clear, the Bundesbank President Jens Weidmann said the same thing. So there's a big difference for markets in terms of aiming at an inflation overshoot in the case of the Fed versus tolerating a moderate and transitory overshoot in the inflation a la ECB. And I think it's all about re-anchoring inflation expectations. That's what we are talking about in the bond market, the long-term inflation expectations and real yields. If this doesn't translate into actual change in ECB policy, which we can discuss in coming weeks and months, then I'm a bit doubtful that the ECB can be successful in re-anchoring those inflation expectations much higher.
Yeah, so Frédéric, how tricky actually will communication be on July 22nd? What are you expecting to hear from the ECB, and are we going to see a bit of volatile markets, or is this a non-event for the markets until we get into next year?
To be honest, I wasn't expecting anything, and even the hopes at the ECB were probably preparing for the September meeting to be the big one, the big decision to be made about the pandemic emergency purchase program, the phasing out of the PEP in 2022, and I'm still expecting this to happen. So perhaps this debate can start and an early announcement can happen as soon as on the 22nd of July. But it goes far beyond that. I think the now focus for markets starting later this month will be, again, to which extent the ECB translates the new framework into actual policy. And to me, the big missing part yesterday is about the instruments, not the PEP, because this is going to be phased out eventually, but the APP, that's regular QE. Will it be increased from 20 billion to 30 or 40 billion next year when the PEP is phased out? That's my expectation. The dual rate TLTRO, can be extended, expanded, improved? Yes, maybe. And this discussion, again, could start much earlier than expected.
Even with those tools, I mean, can we even get anywhere close to 2%? The ECB CPI forecast themselves for 2023 is 1.4%. Is their policy stance just wrong then, or is this a threat of credibility?
That's a good summary. That's the main focus, if not the only thing that the ECB needs to address. Their forecast for inflation, projection, is 1.4% over the longer term, medium term, which is far below the now symmetric 2% target. Even the Bundesbank is forecasting a 1.7% inflation over the medium term. That's also well below the target. So they have to do something about it. They can't go along with what even Mario Draghi has been doing for years and saying that risks are to the downside and more may need to be done. A lot depends on fiscal policy. No, the ECB now has a new framework. They have to provide an answer to this. And again, my answer would be do more with forward guidance, dual rate, and potentially QE next year.
Is it possible that Jens Weidmann and the Bundesbank trip up the ECB a little bit? He's already coming out and saying things that seem contrary to the goal. He says we won't, purposely push inflation higher than 2%. But isn't that precisely what they want the market to believe they will do?
Yes, again, if they're faced with market expectations essentially challenging their view, they have to respond. Otherwise, it wouldn't be consistent with the new framework that they all unanimously agreed on, including Jens Weidmann. So yes, he's coming up with the usual, caution warnings about not expecting the ECB to do something as aggressive as the Fed. Fair enough. But the Bundesbank itself, when it comes to the projection over the medium term, are missing this new target. So I would expect even Jens Weidmann to indeed push for additional measures, or at least tolerate an increase and an easing in the monetary stance next year when the PEP is phased out.
Thank you so much, Frédéric Ducrozet. And thanks to you, actually, Frédéric. I also went back this morning on my journey here to work, rereading the Mario Draghi speech from June 2016. He's global strategist at Pictet Wealth Management. I really know how to live it up, Matt, at 5 in the morning. Coming up, we'll hear from the French Finance Minister, Bruno Le Maire. He is in Venice for the G20. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. It's scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! All the world is possible!
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacroix and Matt Miller. Kaylee Lyons is off today. Just some news crossing the terminal to break for you. Biden to encourage the FCC to reinstate net neutrality rules. This according to Axios. Of course, those rules had been axed a couple of years ago. This allows people to browse the internet, not have to worry about their broadband providers giving preference to certain companies over another one. This had been a long-standing issue for basically the freedom of the internet. So it looks like the Biden administration wants to make it easier for consumers to comparison shop among internet services as well, as part of what seems to be a pretty wide-ranging executive order that Axios is saying is expected to be signed Friday. They're citing people familiar with the matter, Francine.
Yeah, I love this. I mean, this is also the open internet, and I think Austria, for example, has had it for about 5 years. Now, G20 finance ministers and central bankers meet in Venice this weekend. Let's take a closer look at one of the big topics on the agenda, the 15% global corporate tax. Now, the French finance minister, Bruno Le Maire, spoke with our Maria Tadeo earlier today.
I'm very confident, and I think that we could have, during this G20, a groundbreaking agreement on international taxation. And you know that France has been pushing for that international agreement for more than 4 years. So we are on the verge of having this agreement. It would be good news for all G20 member states. It would be also good news, I think, for the rest of the world.
And you know, the Irish, just to give you one example of the countries that are not fully convinced, they say we can work with taxing in the country where you make your services, but the 15%, that's not something we can accept. When you look at this, is this a full package or can you get to a hybrid solution?
Of course, a full package.
So both?
Both. And we need to have a full package. We need to have Pillar 1 digital taxation, the taxation on digital giants being decided. And we also need to have the minimum taxation being decided with a level rate of at least 15%. And let's be very clear, for France, we aim at having more than 15% for the minimum taxation.
So how much would you want to see? You know, what are you targeting?
I don't want to give a specific figure, but I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century, with the digital giants being taxed in a fair way, and with this minimum taxation, which will put an end to the race to the bottom on the taxation system. So once again, 15% for the minimum taxation on corporate tax is a minimum, and France aims at having more than 15%.
And let's just say best case scenario, we get to Sunday, there is this deal, everyone agrees on it, but it will still depend on the US Congress. You also have your own national tax, so what's gonna happen there? Are you gonna drop your tax? That's automatic, and what happens in the US? Are they gonna get this done?
I've been discussing this point many times with Janet Yellen, and we have, as you know, a very good and friendly relationship with the Biden's administration. I want to take a very clear commitment for the French government. As soon as the international taxation and the digital taxation will be implemented, France will withdraw its own national taxation. And I'm ready to take not only a political, but also a legal commitment. In the French finance bill for 2022, I'm ready to introduce the commitment that as soon as this OECD taxation system is implemented and enters into force, we will withdraw our national taxation. I really want to avoid any kind of concern for the US people, not only for the US administration, but for the US people. We are fair. We stand ready to withdraw this taxation as soon as international taxation has been adopted and implemented.
Well, that was the French Finance Minister, Bruno Le Maire, speaking with Bloomberg's Maria Tadeo earlier today. I will also be making my way over to Venice this evening, and hopefully we'll bring you interviews throughout the weekend. Now, let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance, who joins us. Tom, I know you're going to have a conversation about yields, inflation, and
why aren't I going to Venice?
Yeah, I'm going to pick you up on the way. Small detour.
You're going to Venice this weekend?
Yeah.
Okay.
That's all there is to say.
Well, what's important there is Maria Tadeo there at Arsenale out on the east side of Venice. And as you know, that's where the Venetians defended themselves, Francine, against the evil people of Genoa. I mean, the only reason they could fight off the Genoese is the arsenal.
I think my only opportunity actually to talk about the football is the fact that there's a number of memes going out saying it is Genoa, so in fact it's the Italians. They also gave the St. George's Cross to the English to protect them in the medieval ages. There you go. Should we talk markets?
We should talk markets here with a recovery today. We see it across equities, and where we really see it is the inflation-adjusted real yield. There's a lot of research notes out saying, okay, there was a growth slowdown, and we come back here, and just an indication on an intraday chart of how we've come back. We've come down. We've come back about 3/4 of the way this morning, and there's some enthusiasm to that. Bouncing back, Francine, into earnings season next week. It's a growth scare, and maybe it's over.
Tom, I'm looking forward to it. I'll send you a postcard from Venice. Tom Keene,
please send me
Bloomberg
a postcard.
Surveillance.
Really?
We'll look at what else we're watching today. Danny, you're watching space.
I am, yeah. If Tom is impressed, you're going to Venice. I wonder how he feels about.
Okay, traders. As you can see, probably many traders who follow our trades and just wanted to test the strategy thinking right now. Well, why did I try to place an order, yeah, at this level? We're placing stop on profit at 118.44.6. It will give us £1,000 in profit. 44.6. Just right here. Okay, guys. So if you copied, for all of you lucky guys who copied our trades, who decided to follow our trades, please place your stop on profit at 118.44.6. It will give you 10 pips in profit. Stay safe.
Biden, he's going to sign a sweeping executive order today to promote competition. At least that's the idea. Part of that is going to reinstate or try and reinstate net neutrality. And also, we're going to watch what he does in terms of data safety, because the Chinese have tried to take some of their data back, and he will as well.
Right. I'll be watching the G20, and we have a great interview coming up on Monday. This is Bloomberg.
Type of a pullback here just seems natural and normal, and this is not the reason to exit the market.
It's inevitable that the boost from reopening and from fiscal stimulus will fade.
You will get periods of setbacks in equity markets because, that's simply what they do.
We have to take the move in the market seriously.
The market likes higher rates, and people just don't want to buy into that idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is almost the weekend. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic again this morning. Lisa Brambles will be back with us on Monday. Here's your price action right now. Up 11 on the S&P to 43.24 on the S&P 500. Tom Keene, yields can rise as well as fall.
Yeah, they can. I mean, crisis over. There's a huge set of research notes out. Everybody publishing early, John, this weekend off of the growth scare we've seen in the last 48 hours. We'll have a lot of different opinions on that. Conrad de Quadros in moments. But, John, I'm looking at the Bloomberg terminal, and it's telling me this growth scare is on the edge of over.
Yields up 5 basis points to about 134, Tom. I think people are still trying to work this out. Many people believe we're at some kind of inflection point. Mike Wilson over at Morgan Stanley believes the index level correction, Tom, is not behind us, it's still in front of us.
Yeah, I thought Mike Wilson's note was really, really important. The idea he says here is a real correction would be a buying opportunity. To be clear, John, we haven't had that. Wilson's talking, we need 10 or 15% down to be his buying opportunity. Not there yet, but he showed some optimism for equities out 1-2 years.
To be clear, we're down about 7/10, 8/10 of 1%.
It's a plunge
on the week so far. I mean, Romain, when you see yields higher, you know what that means. The Nasdaq's lower, the S&P 500's doing okay.
Yeah, the S&P 500 doing okay. You mentioned it down 0.7% on the week. We should point out the Nasdaq basically flat on the week. I mean, what really got hit this week were the cyclical stocks, some of those small cap names, particularly in the energy and in the material space. So I think when you talk about the growth scare, you did certainly see it in that realm. The question is whether people begin to sort of re-enter some of those bets here. You mentioned the Mike Wilson note. He's talked a lot over the last couple of weeks about this idea that maybe people got a little bit too far afield with that growth trade and that giving up completely on cyclicals may have been a little bit premature.
He's calling it the rolling correction. We'll get into that a little bit later this morning.
There we go.
Nasdaq futures down 23. We're down by about 0.15% for the broader market on the S&P 500. Up 11, advancing 0.25%. And after 8 straight days of yields falling on a US 10-year, yields are rising by 4 or 5 basis points to 133.94. Euro dollar firmer, euro stronger by about 0.1% to 118.57. And Tom, a little bit later this hour, we have got to talk about the ECB's Fed-like strategy. I've got to say, for a lot of people, that was very underwhelming in the last 24 hours.
I love the phrase Fed light. It really had to me almost an American or Anglo-American feel to it yesterday. We can dive into that. But, John, what I would look at is how the real yield is slammed, and I'm using that word very carefully. The real yield is slammed from a negative what? 1.02% up 10 full beeps to negative 0.91. It's a huge move in the real yield as you go into your important program this afternoon.
Never mind my program later, Tom. We've got to push forward to next week. Earnings kick off. We get another CPI print in America, July 13th.
Right. Neil Irwin's article I thought was great last night. I put it out on Twitter, and it goes back to the fundamental linkage, John, of earnings to GDP. The heart of the matter is this boom economy and the raging debate of how long it lasts.
Let's turn to Conrad de Quadros, shall we? Bream Capital Senior Economic Advisor. Conrad, next week. Set us up for next week. We've got the earnings. That's going to entertain the people in equities. Then we've got the data. CPI in America.
Yeah, a lot of important events next week. In addition to the CPI report, which I think is likely to show another pretty elevated reading, not as elevated as the prior 2 months, but we're still going to be looking at core inflation readings that are well above levels that would be consistent with what the Fed has termed price stability. But we also have a lot of growth data as well. We have the retail sales report. We have industrial production. Both of those reports are going to be dampened by supply chain issues in the auto sector. But I think the retail sales report in particular is going to show us that the consumer is in pretty good shape, has a significant amount of excess savings that can continue to be put to work. So I think the underlying details of the retail sales report will be solid. And then, of course, away from the data, we have Fed Chair Powell with these Humphrey Hawkins testimonies, and that will be a key as well.
What I look at, Conrad, is the writing to Quadros optimism. The heritage of your work has always been optimistic about an America that will adapt. Do we underestimate the growth of America?
Well, you know, I have heard a lot about the growth, well, a lot of these growth scare stories because of what's happening with yields. You know, I think if there's a fundamental story there, it's just some rising uncertainty about how changes in the virus and the variants might impact the economy. But I think that if we were to have another wave of infections, and we have not seen that yet, but I think there's some concern about that because of the variants, it will be different this time around. We have better health measures to address it. If we look at the economy, we've just come off last week an increase in employment of 850,000, despite the ongoing supply constraints on the labor market. Demand for labor is still there. Consumers are in good shape. Companies are in good shape in their balance sheets. And so I think there's a lot of reason to be optimistic. I think we're looking at a GDP gain this year, somewhere in the neighborhood of 9%. Sorry, wow. this current quarter, the quarter that's just passed, that's going to be reported later this month. We're looking at a 9% increase in GDP. For the year, we're looking at a GDP gain of about 7%. So, the gap in GDP relative to the trend that we're on pre-COVID is going to be closed this summer, and then we're going to have another year or two of above-trend growth. And I think that that's going to be, something that we should be pretty encouraged about.
Conrad, Bill Dudley, publishing moments ago, is channeling Conrad de Quadros on the labor mysteries of America. He calls it murky. I believe Dr. Dudley will be with us later as well. Conrad, within the labor recovery, will we see wage inflation? Abby Joseph Cohen over at Goldman Sachs was heated that we will not.
I think we're going to see some further pickup in wages. Now, we've already seen some I think, pretty significant increases in wages. If you look at the last 3 months, average hourly earnings are up 5.9% at an annual rate. So, we have seen, if we're trying to get away with the inflation data and the wage data from some of the distortions of last year, so looking away from the year-over-years, if you look at these shorter-term trends, 5.9% increase in average hourly earnings is, I think, further evidence that there is some tightness in the labor market that's not being reflected in the level of the unemployment rate. If we look at the JOLTS report that came out earlier this week, we're seeing high levels of job openings. We're seeing high rates of quitting. All of that to me points to continued upward pressure on wages. Now, on the other side of that, we have the inflation data, which are rising at an even more rapid rate, right? If we get a 4/10 core CPI, which is the consensus forecast for the June CPI, that's going to point to a 3-month increase in core CPI of 8.5%. So, the short run trends, even as the monthly increases are slowing down, we still have these very elevated short run trends in inflation.
And Conrad, though, that still raises the question, though, of how much of that actually feeds into consumer spending here. We've seen several drops now in those retail sales numbers, at least on a month-to-month basis, whether you're looking at the control group, whether you X out autos, whether you X out energy. The trend has been sort of choppy here. And I'm wondering if you anticipate any sort of a meaningful pickup back in some of those retail sales numbers.
Well, one of the issues remain for the retail sales numbers is autos, and that's going to be an issue again next week, where we know from the manufacturers' data that auto sales fell about 10%. Now, that's not a demand issue, and I think that's one of the keys when we're looking at the consumer. This isn't a lack of demand. In many cases, it's an absence of supply because of supply chain problems. So on the retail sales side, I think the underlying details of that report away from autos are going to be quite solid. But we also should remember that predominantly here, the gap in consumer spending is on the services side. And as the economy continues to reopen, we're probably going to see, I think, some strong services spending in the coming months, supported by a labor market that's solid and supported by a consumer that has quite a bit of cash sitting in bank accounts.
Conrad, just quickly, this supply-demand mismatch that's currently developing in the labor market, Bill Dudley this morning pointing out that that's something that typically can be resolved with time. That's one perspective. Another one from Mohamed El-Erian is that you get the price shock and that can cascade through the system, and maybe it's not so transitory at all. Which side of that debate do you fall on right now?
I'm more on the El-Erian side on that because, firstly, the issue is with transitory, what does that really mean? And, a transitory period of elevated inflation, I think the Fed should be in a better position to excuse that when we have actually had a period of low inflation. But now what we've had, you look at the last 5 years, PCE inflation has averaged 2%. So what prior miss are we trying to make up for now? There really isn't one if you look at 5 years. So looking forward now, we have these issues of the supply chain. You look at things like what's going on with shipping and look at shipping costs between Shanghai and LA. They're up multiple times of where they were a year ago. And those are still price effects, even as the Fed's focusing on things like lumber coming down and used car prices aren't going to boost the CPI anymore. There's all of these other price effects in commodity prices and transportation costs And even as I said earlier, in labor costs picking up, that still have to feed into prices. And I think that that's an area that's going to keep inflation elevated for some time. And that's a key, I think, when we consider the fact that we don't really have much of a miss to make up for anymore.
Yeah. Conrad, it's good to hear from you, sir. Conrad de Quadros, Bream Capital Senior Economic Advisor. Tom, I framed the debate that way because, of course, at 8:15 this morning, Eastern Time, we'll catch up with Mr. Bill Dudley, the former New York Fed president. 45 minutes after that, we'll catch up with Mohammed on Bloomberg TV as well. It just gives you those two perspectives on this situation at the moment.
Now, what's interesting to me, John, is there's not two perspectives. There's about 5 perspectives here.
That's a good point,
on
too.
the hugely fluid dynamics. What I'm falling back on, John, is I'm looking at the Bloomberg terminal. I'm looking at the correlations or lack thereof of equities, bonds, currencies, commodities. I don't have currency moving this morning, even though sterling under a 138. Oil's not giving me much, maybe mid-range. But John, to your point, you go to the fixed income market and look at those dynamics, and it says gross scare over.
Yields are higher by about 4 basis points to 133.60. And remain, we talked about it about 5-10 minutes ago. That relationship between this bond market and certain compositions of this equity market still intact.
Yeah, still intact here. And I think that when you start to see these yields come back up, you still have to kind of keep in mind where we are and where we've come over the last couple of weeks here. The growth scare might be over, but I think some of the imbalances that this market's been trying to work through is still going to take some time before we finally get to the end of this.
What kind of growth scare is over after a morning of high yields that have lasted about several hours, TK? You want to make that call? It's 6:11 Eastern Time. We're up 4 basis points. It's over. Okay.
Yeah, John.
Maybe it is. I don't know.
I'm researching here,
in the
John.
process.
John, is Italy really won 33 matches in a row?
Yes. We're on a
Really?
30-plus game winning streak. Is it 33 now?
That's like better than the
We're up
Padres.
to 33. We're doing nicely. We're doing well. I don't want to talk about that game too much. I was talking to friends yesterday. I'm pretending it's not happening.
Why?
Unless we win, of course.
What are you, nuts?
43.21 on the S&P 500, up 8 on the S&P. We advanced 0.2%. NASDAQ 100 futures down 40. We're negative on treasuries. Yields are higher by 4 or 5 basis points to 133.77. What a week we've got coming up next week for you. Chairman Powell testimony down in D.C., and we get CPI data, and earnings season kicks off from New York.
Major League Baseball All-Star Game.
Lovely. This
Thank
is Bloomberg.
With the First Word News, I'm Rishika Gupta. The Biden administration reportedly will add at least 10 Chinese entities to its economic blacklist. According to Reuters, that could happen today. The move has to do with China's alleged human rights abuses and high-tech surveillance in Xinjiang, the homeland of Muslim ethnic Uyghurs. China has pushed back strongly against the criticism. It says the U.S. and its allies are bullies. Pfizer plans to request U.S. emergency authorization for a 3rd booster dose of its COVID vaccine. That's after data showed it can sharply increase immune protection against the coronavirus. Still, federal health officials signal that they would take a cautious approach to potential booster shots. President Biden reportedly will encourage federal regulators to reinstate net neutrality rules, according to Axios. He'll sign an executive order that also would make it easier for consumers to comparison shop for internet service. Net neutrality rules bar the blocking, slowing down, or paid prioritization of web traffic. They were repeated by President Trump's FCC. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our military mission in Afghanistan will conclude on August 31st. The drawdown is proceeding in a secure and orderly way, prioritizing the safety of our troops as they depart. U.S. support for the people of Afghanistan will endure. We will continue to provide civilian and humanitarian assistance, including speaking out for the rights of women and girls.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic, counting you down to the open about 3 hours away to get you set up. Here's the price action this Friday morning. Good morning to you all. Equity futures are positive. They're up 9 or 10 points, positive 0.2%, set to take a little bit of a nibble, a bite out of a weekly loss. Over to the bond market where yields are higher. That's really set the tone for the day's price action throughout the last couple of weeks. Yields are higher by 4 or 5 basis points to 133.94. And the euro a little bit stronger. Euro dollar positive 0.12%. TK euro dollar 118.59.
118.59, a little bit of a pop-up off the Lagarde news, but not all that much. We'll get to ECB here again, and Bill Dudley joining us later today. I'm looking at futures up 10, a better tape. Right now, Anne-Marie Horton of Bloomberg in Washington with us this morning. Anne-Marie, to those with a collective sense of history, and I think of the interviews I've done over the years on Afghanistan and on Iraq, it is really not so much buried in the news, buried in the headlines, but we're just sliding away a bit. What has been the Capitol Hill response to President Biden saying, no, we're not going to ask how many more years?
Yeah, well, Tom, that press conference he gave yesterday came under a lot of pressure from the press answering these questions. I think many think that his decision is quite firm given how strongly he was rebuting the press on why they are leaving. Of course, one thing he did say that was key was that it's not inevitable that the Taliban would take over the entire country, right. But he did allude to the fact that it isn't going to be a country that is going to be governed by just one. Right now, the U.S.-backed Afghanistan government only controls about 20% of the country.
I'm confused, Anne-Marie. Who is against President Biden here? Are there Democrats or Republicans saying we need to stay fully committed or partially committed to this 20-year effort?
So it's interesting. The Democrats are certainly supporting it, and a lot of Republicans are as well, Tom, but they're doing so in a much more quieter fashion. Really, what the concerns are is not that the United States should continuously stay in Afghanistan, but the concerns are what happens because if we leave. Is there a planned political handoff? Is it going to be a safe place? We already see Afghanistan refugees really just fleeing the country. One of the key things to keep an eye on is if the Turkish government is going to be able to maintain a strong control of the Kabul airport. If not, what happens there and in the United States Embassy in Afghanistan? So I think it's more from the military part of Washington, just asking these questions about what happens next and how to make sure that as the United States leaves, that they are leaving so in a fashion that at the best way we could support the Afghanistan government.
And Ray, let's stay on foreign policy just a little bit longer. Away from Afghanistan, a separate situation, and let's go to the Middle East and sit there just for a moment. What's the broader strategy there now from this administration?
This administration is certainly keeping an eye on the Middle East. We saw that there's issues right now and discussions with Russia in corridors with Syria. There's also discussions about the Iranian nuclear deal. Well, at the moment, those talks are pretty much just in purgatory. We're supposed to have a sixth discussion. But really the focus, Jonathan, I would say is less so on the Middle East, less so on Europe, and the focus is on China. And you saw that overnight, Reuters reporting that it's already taking aim at another 10 Chinese entities due to human rights abuses. So, of course, the entire foreign policy. They're going to look at every corner of the world, but really the focus of this administration is being tough on China.
This feels incremental, though, Anne-Marie. With the previous administration, they were heavily criticized for the moves they made, but it felt much bigger. What's the approach this time around from this administration, and how different is it?
I think the approach from this administration is to just do so multilaterally. President Donald Trump, and what is so different from President Biden, is President Donald Trump took on China very much so as himself, as the own Trump administration, one-on-one against Beijing. What we saw on the heels of the G7 and then the NATO summit with President Biden was to try to get Germany, the United Kingdom, France, all on board in tackling and going up against China.
Emery, let's stick on foreign policy here. Talk about Iran and the idea here that this administration came in with, I guess, the intent here to maybe try to revive that 2015 nuclear deal here. A lot of reports this week here about the progress Iran has made with regards to enriching uranium, and the idea here that salvaging that deal now is a lot harder than maybe it looked a few months ago.
Yeah, there's a number of items going into this Iran nuclear negotiation that make it so much harder. One is that you have a change of a regime. You have Ibrahim Raisi, a cleric that's coming in August. He's sanctioned by the United States. This is going to be someone who has called the Iranian nuclear deal something that is moderate in terms of how much he wants to put emphasis on it. You do have Iran as well at the moment not having those special IAEA monitoring committees being in the country right now. So right now the IAEA is supposed to have this in-depth, detailed security of the Iranian nuclear enrichment, and right now that is on hold. That has not been extended. So there are a number of factors going into if they have a sixth round of discussions that are making it much more harder, that are going to able to actually clinch the deal.
Did we get an OPEC deal in the end? What on earth happened to that? That was the news at the start of the week, and then the week's grown older and no one's talking about OPEC anymore.
Classic OPEC. There's no deal. There's still talks. But the fact of the matter is, and what is so different from last year, is that the market is in deficit right now. So I don't think the market actually cares that there's no OPEC deal.
Right.
If they all start pumping at will, okay, who cares? The world needs that oil.
John, did Anne-Marie come back from London with a British accent?
Why'd you say that?
I hear it, you know?
What do you hear?
I hear a British accent.
Never.
I don't hear the
I don't
British
think,
accent.
but, you know, I hear it a little bit.
I've lost my T's since I've been here. I
Thank
now
God.
pronounce them as D's, which apparently is what you do over here.
Oh, really?
So it's
Thank
not
you.
butter, it's butter. and it's
John,
not
I still
water,
can't understand one out of
water.
5 words you say.
You still
I
don't
swear,
get it, Tom. I
Anne-Marie's-
adjusted my T's just for you. I
Does
did
she
that just for you.
Does she sound like the BBC or does she sound like Sky? I can't figure it
don't think
out.
she's changed.
Okay.
I think she's still got that Long Island twang, Tom.
She's the only one on the show that's actually had tang besides me.
Anne-Marie Hordern, down in Washington, D.C., our Washington correspondent. Anne-Marie, run. That's what we used to say to Kevin every day, run. And now saying it to Anne-Marie. Your bond market looks like this, up 4 basis points on 10s. Yesterday we had a break of 125. It was a brief break. Now we're north of 130 at 133.44. And in Tom Keen's words, growth scare
Growth scare.
over.
Oh,
Yeah,
come
look,
on.
Your call, not mine.
John, I'm so upset at how apoplectic we get. Down 0.7%, down 1.7%, whatever it was.
Well, to be clear, Tom, in the equity market, sure, at the index level, we're down about 0.7/8% at the index level. But for the bond market, that's a real move. To see the break of 125
well, the bond
yesterday,
market,
that's a
come
real
on.
move.
The bond market is so distorted right now, John. It's in no textbook. It's not in Fibonacci. You know, we're making it up as we go.
We can talk to David Kelly about that.
Yes,
we'll
we
do that
can.
next from JP
Brilliant.
Morgan Asset Management.
He's an Irish
global
accent.
strategist. Well done, Tom. You're
Thank
good
you.
at this. 43.25. This is like Sesame Street, isn't it?
It is.
Up 13, up a third of 1%. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City for our audience worldwide this Friday morning. Good morning. Crisis over, if there was a crisis, according to Tom Keane this morning. That's his line, not mine. Just to re-emphasize that. Your equity market, 43.24 on the S&P 500, advancing about 1/3 of 1%, up about 11 points this morning. Nasdaq 100 futures pulling back by 0.2 of 1%. We're negative 27 there. I think you can guess where the bond market is. Switch up the board, 2s, 10s, 30s, shaping up as follows. This is your nominal yield on a 10-year, 133.44, advancing about 4 basis points here. On a 30-year, still sub 2% at 196.85, heading north by about 4 basis points this morning. This is the Treasury curve. I'll talk about that a little bit later this morning. This is what I want to talk about now. Switch up the board and get to Germany. Your German 10-year is still at negative 30 basis points, negative 0.2299%. Negative 0.299% on a German 10-year. So we had this shift over at the ECB and no one got excited about it, and you wonder why. Well, they've gone from an inflation target of below but close to 2% to just 2%. You would think that maybe that has trimmed the Bundesbank's wings just a little bit, but no. Jens Weidmann, the Bundesbank president, comes out a little bit earlier this morning and says we will not seek an overshoot of that inflation target. Now, Tom, over at the ECB, this is not flexible average inflation targeting, because if it were, we've undershot that target for a decade plus over in Europe, unlike the United States, and that is not what is going to happen in Europe. So what's going on here, Tom? Do they have any control over price stability over at the ECB?
Oh, come on, it's politics.
Can they achieve their target? Do they have a credibility issue? And can they do anything, TK, to get this German 10-year back in a positive
John,
territory?
I've sat in the office with Otmar Issing a long time ago. It was really quite an honor to see the blueprints for the new building a million years ago as they were building the edifice of the ECB. Nothing's changed since Otmar Issing showed me those blueprints. The bottom line is it's a political exercise. Yeah. It's original monetary theory with a fiction of a fiscal combined union, and the answer is they're making it up as they go.
And they're still making it up.
Yeah.
Tom, you and I have spent a lot of time over in Frankfurt, Germany. We've got a wonderful team over there leading our central bank
3-hour lunches.
They will remember the line that President Mario Draghi used to use continuously. The rates needed to be low now to be higher in the future. Tom, we're pushing 10 years of talking about that. They need to be low now to be higher in the future. There's your future right now in Germany. Not looking so bright, is it?
The 10-year yield, and again, the Swiss 20 years of benchmark I use, that turned to a more negative yield this week. Right now, and it is the research note of the week, David Kelly joins us. He's with JP Morgan Asset Management because he moves away from his expertise in investment and finance and his legit expertise in economics to the human condition. David Kelly talks to us about the reality of his family after the storm, after a horrific tornado, and the Kelly family recovered. David, I love your note and the idea that we underestimate the human spirit out of some form of disaster like a pandemic. Do we underestimate the global growth recovery?
Yes, I think we do. I mean, I think we're so shell-shocked by the pandemic that we are underestimating the impact of these vaccines and the impact of growing immunity around the world. So we've got this, Delta variant. I think that is scaring people. I think the increase in cases in some parts of the United States is scaring people. But if you look at the broad picture is that we think over 75% of Americans now have some immunity to COVID-19. And if you look particularly on the coasts, it is, declining very rapidly. So we think the economy is coming back to normal. It's coming back strongly. And sometimes people get deflected from that message, but I think that's the broad picture here.
Sum for us the JP Morgan view on off the mat of February ago, this titanic equity boom that we've seen. Does the equity boom continue with this growth recovery?
Yes, I think it does for a while here. I mean, there's still a huge amount of liquidity sloshing into the economy. I mean, one of the things I mentioned in that note is, one of the remarkable aspects of this landscape is somebody's turned on the fire hydrants of liquidity, both on the fiscal side and monetary side, and nobody seems interested in turning them off. So we've got all this liquidity pouring into markets, and while central bankers think about consumer prices, asset prices still are being helped by all this liquidity. So I do think stock prices can move higher on this. I do worry a lot about valuations, particularly for the more expensive stuff here, because when eventually rates rise, I think you're going to have a problem there. But for the moment, I think the economic and monetary background backdrop is very favorable for equities.
You say eventually, David, so let's get into that. I mean, we've gone more than 10 years, I think, now, with the ECB not raising interest rates since the 2011 Trichet hikes. For Japan, it's been a lot longer, David, as well, of zero interest rates. For the Federal Reserve, do you think they could get trapped down here?
No, I think there's a big difference, which is we've got no fiscal caution whatsoever. I mean, the big problem in Europe and in Japan is they've been doing, half an aspirin worth of fiscal stimulus all the way along, and it's just never got anything going. And keeping interest rates low at these levels does not stimulate anything. So they've been permanently, sedating their economies with these very low rates and anemic fiscal policy. Here in the United States, it's a different matter. I mean, we've got, I still think we're likely to get an infrastructure package, a reconciliation bill passed through. We've got a lot of money still pouring into the economy. We're going to get these first checks on the child tax credit coming in on the 15th of July. For many families. So I think we've got a lot of fiscal stimulus here. And as the unemployment benefits lapse, or the enhanced unemployment benefits lapse, I think we'll see a lot of job growth. So there's just much more economic momentum here in the United States and a lot of fiscal push. And so I think that's going to get us back to full employment. Inflation is going to stay relatively high. The Fed's going to have to change its tune.
David, in the past week, BlackRock downgraded U.S. equities to neutral. They're looking abroad. Would you maintain a relative overweight to the US versus the rest of the world still?
No, not for a long-term investor. I'd actually agree with them. I think, despite everything I just said, all of that and more is baked into the relative difference in valuations around the world. International stocks look extremely cheap relative to the US, and that gap's only grown. So, right now we're booming, but we'll have to slow. Right now, the rest of the world, particularly Europe, it's gathering some momentum here. So, despite what I said about policy, I think economic reality is that U.S. stocks are probably a little expensive relative to international stocks, and I'd want to increase my allocation to international.
David, how much attention are you paying right now to some of the movements that we've been seeing in the commodities space here? I mean, that seemed to be a pretty good indicator of the growth story for quite a few months here. And the last 6 to 8 weeks here, we've seen some tempering in the prices.
Yeah, well, we've seen, there's some areas like lumber, of course, where prices just got, ridiculously high and have come back down again. But if you look at the overall commodity indices, they're more sort of flatlining than anything else. They're not exactly keeling over here. And I think the other part of the story that has not been present in other expansions in the last 25 years is we're seeing a lot of wage growth. And we've got a statistic on the year over 2 year wage growth in the United States is at its highest since 1983. You know, if you go through the pandemic and back before it, we've got a lot of wage growth building here. So those things tell me that, you know, we have moved into a new old normal where inflation will be running above 2% rather than below 2% in the United States.